are still trying to decide whether it's going to get above 5,000. And I think it's going to probably, possibly today, but probably this week. The market has been in a really strong rally. You can see it on the weekly chart. The red circle means 8 consecutive bull bars on the weekly chart. A second red means 9 consecutive bull bars. And then I talked about this several times. If you go back over the years, if you get 8 or more consecutive bull bars, you're in a bull trend, and the market, after having a pullback, will make a new high. And that has happened in the past 10 or 15 years every time. Here, we went up for about 5, 6, 7 more weeks before we get a bigger pullback. Here, same thing, 8 weeks, 8 consecutive bull bars. We pull back a little bit, pull back a little bit more. So right now we're at this point. We've had the first pullback and we're here. We'll probably get a bigger pullback. That'll last about a month. A month is about 4 or 5 bars. Here we had 8, 9, 10, 11 consecutive bull bars. Even though we sold off a lot for several months, we went on to a new high. And we've never had, at least not in the past 10 or 20 years, we have not had 8 consecutive bull bars in a bear trend. So none of the bear rallies lasted 8 or 9 weeks. Anytime you have a bear trend and 8 or 9 bull bars, it's the start of a bull trend. So, we're probably, I think we're going to go higher, but I also think that we're not going to go much higher. Maybe we'll go for, 5, 6, 8 weeks or so, and then pull back at least to this level. I suspect we're going to get more of a pullback sometime in the first quarter. How much? Let me just throw up a daily chart. On the daily chart, an extremely strong rally. And then we had trading range trading here. So the market thought this was a fair price. And now we're above that fair price. And typically the market will come back down and test that fair price. So this might be the final bull flag. As I said, it might go a little bit higher, but I think we'll come back down and test this area, 4,700, maybe a little bit below, maybe all the way down to 4,600. But I think sometime in the next few months, we'll be back down in this area. Right now, we're getting bear bars. Yesterday was an inside bar after a new high in this rally. We're just below the all-time high. But a bear bar is a bad buy signal bar. And it's also a third leg up. 1, pullback, 2, pullback, 3. So there probably are sellers not far above yesterday's high, not far above that high, which is the high for the year. And probably sellers around 5,000, which is this high got within a tick or two of it, and then the all-time high. So there's resistance around here. So I think that will probably go up for another week or 2 or 3 or 4, but stall somewhere around 5,000 or the all-time high, and then work our way down to 4,700, 4,600, somewhere over here. Yesterday, we had a sell-off on the open, and pretty dramatic here, here, and here. And it was simply a pullback to the 60-minute moving average. And the bears got exhausted, and they bought back their shorts. This little sideways trading area was the final bear flag. It's also a third leg down. 1, pullback, 2, pullback, 3. It's a bull bar closing near its high, a very good-looking bull bar. So it's a reasonable buy. The first reversal might have been minor, but because of the wedge, the final flag, and the test of the 60-minute moving average, there was a chance we could just go up in a small pullback bull trend, which we did. We had a series of bull bars here, and then this doji was the start of a trading range, and we were sideways for the remainder of the day. Expanding triangle, up, down, more down, more up, more down, and now we're going up again. So a small pullback bull trend, and then the bull trend continued to here, but the trading range, I think, began here. And then when you see something like this, at one point this was a big bear bar closing near its low, right? Well, when the bar closed, it was on closing near its high. This was simply a test of this. For the bears, they had 1, 2, 3, and a bear bar. So for the bears, they have a bear trend and a wedge bear flag, but it's a tight bull channel. So, and it was also a sell climax. And at this point, it was also a small pullback bull trend. We're trending up, so it's a bull trend. We have a small pullback, a small pullback. So even though it's a wedge bear flag, it was a low probability bet. So, and plus you have a tail on the bottom of the sell signal bar, and the close of the sell signal bar is above the moving average. So that collection of facts made it likely that a reversal below 26 was going to be minor. And then we had a little breakout and follow through. So the top of the wedge is here or here, a little doji bar, and then a breakout and a follow through. So you got to be thinking, this is probably going to rally for the measured move, for about a measured move. So from that low to the top of the bear flag, which was exactly equal to here, and then we reached that measured move. I want to say something about this. They changed the price. That's interesting. Okay. Yesterday, the open of the day was the high of the day. Right? And it's rare for the open of the day to be either the high or low of the day. And when it happens, the market usually comes back and goes beyond the open, or in this case, the high. Yesterday, all day long, the open of the day, this first bar, bar 1, and the high of the day were exactly at the same price. Today, they changed the price of the open or the high. I guess which one did they change? It looks like they may have changed. No, I forget which. But they made the high of the day one tick above the open of the day, and they did this overnight. Yesterday, all day long, the open was exactly at the high. And when that happens, it's a magnet, and you're usually going to go back above it. Now, I want to say one other thing about this. Whenever you have a big sell-off on the open, in a tight channel, it's climactic and unsustainable. And typically, you're either going to go sideways for a couple hours and then decide whether to reverse up or continue down, or you're going to do this. You're going to reverse up. And we reverse up. And when it reverses up, it usually reverses up in a small pullback bull trend. And sometimes it goes above the earlier high, which it did, but only rarely does it go much above the earlier high. So when you have a big sell-off on the open and then a reversal day, it can go up for the remainder of the day, but it usually has a hard time going much above the earlier high. So this is kind of a typical type of day. Yesterday is Monday, first day of the week. And so it's open as the open of the week. And that's important because the weekly chart has been having so many weeks with bull bodies. The bulls obviously want another one. And the bears, what is this, 13 weeks now? This is the 14th week since this low. There has only been one bear bar, which is really unusual. And so it increases the chances that this week will be another bear bar, another red bar on the weekly chart. And therefore, traders are paying a lot of attention to the open of the week. And you can see yesterday we oscillated around it for a couple hours at the end of the day. We're near the top of yesterday's trading range. We broke above the moving average. We broke above yesterday's close, so we have a gap open, an intraday gap between today's open and yesterday's close, and above the moving average, but we're at the top of the trading range. Also, yesterday opened over here and it closed lower. It's a bear bar, as I said. Over here, I put the daily chart down here, and it's a bad buy signal bar on the daily chart. So, I expect we're going above 5,000 this week. So I expect we're going to go above yesterday's high, but yesterday's high is a bad buy signal bar, and therefore the rally above yesterday's high might just be a day or two, but that's really all we need to get above 5,000 and make a new all-time high. The cash index is already at a new all-time high. Here's the cash index daily, and here's the weekly chart, here's the monthly chart. And you can see in the cash index, the market is already at a new all-time high. But on the daily chart, we're below the all-time high, the high that came after the pandemic. Let me turn that back to the daily chart. There's still a wedge rally. We're far enough above this line, so this is probably not the first leg of a wedge. So maybe the bull channel began here, and we still have room up to that bull channel. Markets pay a lot of attention to channels, and there are often many ways to draw channels. The market often goes beyond the channel before reversing, and then you just draw a new channel on. For example, on the way down here, initially that's your channel, and then it keeps going down, so now maybe that's your channel, and then here it broke below it, so that's your channel. So you constantly, with each new extreme, you're redrawing the lines. This is a lot of bars. This is, again, the weekly chart. This is a lot of bars without much of a pullback. So I suspect we got a bigger pullback. Also, when you look at this chart, you say, wow, what a strong rally. It's a very tight bull channel and a lot of bars in it. So it is a really strong rally. But the sell-off, we kept getting big thrusts down, big pushes down here and here and here and here. And even on the way up, we've had a lot of big sell-offs. And that's really trading range trading. The bulls are hoping this is a bull flag and that this is a resumption of this. And at the moment it is, but it's also still a bull leg in a trading range. And I think this relentless selling was very strong, and obviously it was relentless. When you get that kind of a market, usually the bull trend does not resume. Usually you have to test back down, maybe to this low or that low. So I think that before we get much above 5,000, 5,500, somewhere up in this area, we'll come back down and test this low, maybe this low. And I do think we're going below this low at some point in the next 3 years or so. So for the bulls, we have a bull trend. The gap up is a bull trend. And we have a pullback. But the first bull bar has a prominent tail. The pullback, it's a high one in this bull trend. It has a bear body, and we're right below yesterday's high. So that's really not a very good swing buy. So I would wait. I wouldn't do anything yet. We're at the top of our trading range, so we may come back down and test yesterday's close. I want to say one other thing about this. I talk about how 90% of days have at least one swing trade. And by swing trade, I mean many things. But usually it has at least a couple legs. Usually it lasts a couple hours, sometimes only 1 hour, sometimes 3 or 4 hours. So, but my starting point is a couple legs, a couple hours. And it begins with a good buy signal bar. If it's a bull swing, if it's a bear swing, it begins with a good bear bar. So a bear bar with a decent sized body and a close near its low. So yesterday on the way down, we broke far below the opening range, a big bear bar closing near its low, and a follow through bear bar. So you could sell at the market, or you could sell below that bar, or you could even sell below this bar and hope to make 20 points. If you were short, you'd definitely get out of this, a possible final flag, a lower low double bottom, a parabolic wedge, and a really good looking buy signal bar. So this is a good swing up. It's a good example of a Walmart trade. I'll talk about that in a moment. Do you buy above 3 here? Now, I'd like to see it break strongly above yesterday's high. I'd like to see it have consecutive gold bars closing the other highs, and then go ahead and buy. We just broke above the Globex high. 90% of days either break above the Globex high or above the break below the Globex low. Yesterday we broke below the Globex low. Now we're breaking above the Globex high. Let me turn this into a day session chart. This is a good example of a Walmart trade. I use that term. A lot of traders, they'll take the trade and they'll scalp out with 5 points, and then they'll watch this and they'll say, oh my gosh, I want to pull back, I want to pull back, I want to pull. Well, everyone wants to pull back, and that's why it's not pulling back. And the reason why it's not pulling back is because traders are confident the market's going higher. And if you're a computer, what you're doing is you're buying more, you just keep buying more and more and more because you're confident it will go higher before there's a pullback. So if ever you see a situation like this, and let's say you bought this and you scalped out at 5 points or 10 points, and then you start to see this, 2, 3, 4 bull bars, and you might be going up for a measured move, you might get back to the open of the day. The easiest thing to do is you can either buy with a limit order at the low of a prior bar, especially a bull bar right there, or you could wait for a bull bar closing near its high and then buy with a stop above its high. And if you get a bear bar, a couple bear bars, you can always exit below the low of a bear bar and then buy again above a bull bar closing near its high. So you buy there, maybe get out here with a small loss, and then you buy here. Do you get out here, a little wedge, lower high, 1, pull back 2, pull back 3. Again, it's one of those really tight bull channels. I personally would not get up below that. I would take a chance that we're going to go higher. I have a magnet at the open of the day, and a reasonably strong trend. So, and if you did get out below, if you did exit your long below that, you could buy again above that. Can you short below that? As I said, I wouldn't do it. This is a small pullback bull trend, and it's within a bigger bull trend. So I would want to see consecutive bear bars with decent sized bodies like that, and maybe get out below that. I'm not going to get out below a relatively small bear bar and a small pullback bull trend where the close is near the moving average, but not below the moving average. Here, close below the moving average, better chance of going lower. Okay, so we just went above yesterday's high, but it's a bad buy signal bar on the daily chart. You turn this back to the daily chart over here. So bad buy signal bar. Plus, it's an expanding triangle, and expanding triangles they tend to reverse. An expanding triangle is a triangle, and a triangle is a trading range. And triangle has 5. It's a trading range with 5 turning points. So 1, 2, 3, 4, 5. So this is the start of an expanding triangle. 6, now 7. There's hope that they get a good sell signal bar for a swing down, maybe to the low of the triangle, maybe the 60-minute moving average. Yesterday's range is not all that big. It's possible we can go outside down. I doubt that we will. And the bulls know that every time we made a new high over the past several hours, we reverse. New high, reverse. Rally, reverse. New high, reverse. And the bulls don't want that to happen. So they are buying into the close of this bar, trying to prevent it from closing near its low. The more it closes near its low, the more bulls will give up and the more bears will short, taking a chance it's the high of the day or the start of a swing down. If there's a fairly prominent tail on the bottom of the bar, traders are not going to go short. And that's exactly what we have. We have a fairly prominent tail. So expanding triangle, they'll break out above yesterday's high. Some computers will look at this as simply a higher high double top. But whatever you want to call it, it has a fairly prominent tail. That will reduce the number of sellers below bar 4. Possible low of the day, but a lot of traders, instead of selling below 4, they'll wait to see if 5 closes near its low, and then they'll sell below 5. There has not been a good buy signal yet today, so most traders should be flat. We have a bad buy above 2, a bad buy above 1, a bad buy above 3. You're at the top of a trading range. It's better to wait for 2 big bull bars closing near their highs. We only have 1. So there was no good buy. And here we have a higher high double top or an expanding triangle. but we have a big tail below 4. So it's not a good sell, not a good buy, not a good sell. Best choice, wait. And when there is not a good buy and not a good sell, it's a limit order market. And that means the computers are selling anything bullish. You go above the high of the prior bar, go above 2, you sell. You go to a new high of the day, you sell. You get a big bull bar closing near its high, you sell the market, you sell above its high. You go below something, you buy. You buy it at the 4th low, at the low of 4. You buy at 1. You buy 5 points below, 10 points below. And the bears have sold the high of 2. They sold more 5 points higher. And it gets back to their original sell price. They get out break even on their first sell. That created that tail with a profit on their higher sell. So it's all limit order scalping. Scalps in the E-mini currently are 5 points. The swing trade in general is about 4 times the size of a scalp. So if a scalp is 5 points, a swing trade is 20 points. The average days range on the daily chart, some days have been 70 or 80 points, some days have been 30 points, but the market has been averaging around 50 points. A swing trade, in addition to being 20 bars, 2 hours, and 2 legs, as a generalization, a swing trade also reaches about 40% of the average day's range. If the average day's range is 50 points, 40% of that is 20 points. A swing trade is also 4 times as big as a scalp. A scalp recently has been 5 points, so and 4 times bigger is 20 points. 20 points is 80 ticks. If you buy 1 tick above bar 16 and you place a limit order to get out 80 ticks above your entry, that's 81 ticks above 16. The market has to go 82 ticks up for your order to get filled. So whenever you have a good buy signal bar and you're looking for a swing up, you need the market to go up 82 ticks for you to get filled. So 5, 10, 15, 20. This is 20 points and it broke strongly above it. So there was not a lot of profit taking here. That increases the chances that we're going to go at least a little bit higher. Sometimes it'll go 81 ticks and pull back. And that tells you that there are a lot of limit orders to sell there. Sometimes it'll go 82 ticks and pause or go sideways or pull back. That tells you that a lot of traders feel like it's probably going about far enough. But when it breaks fairly far above 82 ticks, you're probably going to go higher. So it went sideways a little bit and went higher. You can see the limit order bulls, they made money. They bought the 4 low. They placed a limit order to buy more, 5 points lower. Okay, now the low of that is 49.72 even. And this is 49.67.50. So it did not fall far enough for the bulls to add on. You had bulls who bought the 4 low. They wanted to buy lower, but it could not get below 1. There were so many limit orders. Other bulls were simply trying to buy at or above 1, trying to prevent it from going below 1. They didn't want a new low of the day, afraid that it would then go down here. So bulls have a lot of limit orders to buy at or just above 1. And that prevented the bulls who were trying to buy 5 points below 4 from getting filled. So a lot of the bulls who bought the 4 low were unable to scale in below, but they're probably disappointed that we fell this far. A lot of those bulls placed limit orders to get out at that 4 low, and that's why we're stalling here. You have bulls selling around break even. They bought the 4 low, they were just a little bit above the 4 low, so they were able to get out. Now we have a small double top, 1 and 4, a higher high double top, and then we have a double bottom here. We had a bad sell signal bar 4, and we have a double bottom 1 and 5, but a bad buy signal bar. It's a bear bar. Plus, it's at the top of a trading range that has lasted 3 or 4 hours. So another bad buy signal bar, like 2. Better to wait. And you could be a limit order scalper, but you will lose money. For example, yesterday, a lot of prominent tails, a lot of sideways trading. Let's say you bought the 4 low. It didn't go up far enough for you to make a scalp. Maybe you get out break even below 6. Maybe you bought more at the 6 low. Maybe you bought more at the 3 low. Then what do you do when you see 7? If you use a wide stop and say, I'll scale in. Well, if you could use a wide stop and scale in, 80% of the time you're going to make money. But chances are, if you bought that 6 low and bought more 5 points lower, you would not buy more, you would not double your position size down here. So it's a bad strategy unless you can trade small and use wide stops and scale in. And most traders cannot do that. If they bought the 6 low and bought more 5 points lower and then saw a 7 and 8, they get really, really scared. And then they see another big leg down, another big leg down. They can't take this buy. And if they took that buy, 80% of the time, they could get out without a loss. 80% of the time, it'll go to the midpoint of your first reasonable buy at the 6 low, and the second reasonable buy above a good bull bar closing near its high. So let's say you bought the 6 low, and let's say you bought more, 1 tick above 16. Okay, that's the midpoint. If it gets 1 tick above that midpoint, you can get out break even. You'll have a loss that big, and you'll have a profit of the same size, and you can get out break even. That's part of the reason why this topped out exactly right here. You know, a lot of traders who did just that. But so 80% of the time, if you take a reasonable trade, it goes against you, and you buy more above a bull bar closing near its high, you're going to get 1 tick above the midpoint, and that will allow you to get out break even. You can see the high of this bar. It's almost exactly at that. I don't have this drawn in precisely, but I suspect that that high is 1 tick above that midpoint. So 80% of the time, if you take a reasonable trade and do a reasonable addition, doubling your position size, it's going to go 1 tick above your midpoint, and you can get out break even. And 60% of the time, it's going to go all the way back to your first buy. So a 60% chance we're going to get back to that 6 low. And that's really good math. So let's say you're a bull and you did not buy the 6 low, and you just waited for a big bull bar closing near its high and then bought this. 60% chance you're going to get all the way there. So 60% chance you're going to get more than 20 points, a swing trade. And your stop would be below 16. You maybe put your stop a little bit further down, 5 or 10 points below. With some really good math for the swing bulls yesterday. Bears trying to get big bear bars closing near their lows. They want as many consecutive bear bars as they can get. And they want bear bars closing below important support. The low of the day, the double bottom 1 and 5, the moving average. This dashed line is the 15-minute moving average. It's this blue line over here on the 15-minute chart. And this dashed line is the 20-bar exponential moving average on the 60-minute chart. You can see yesterday we collapsed and reversed up from just below, and this is what happened. Here's that 60-minute moving average, and on the 60-minute chart, that's it right there. Went below it, reversed up. The sell-off over here was really strong. The rally lacked consecutive big bull bars. It's fairly weak, so it looks like we probably have to have a second leg down. There's the 60-minute chart. You know, big up, big down, big confusion usually leads to a trading range, and a trading range has legs up and down. So when we went down, we went up. You probably have to come down near yesterday's low. I don't know if we'll do it today, but it looks like trading range behavior. And then you look at the 5-minute chart, and clearly trading range behavior. Every time we get a new high, they sell it. Every time we get a new low, they buy it. So when you short this, well, we're going down to yesterday's close, probably down to the 60-minute moving average. So, and we have 3 consecutive bear bars. It's okay to sell at the market or okay to sell 1 tick below 6. But, well, do I think we're going to go a lot below 79 in the 60-minute moving average? Right now, I do not, but we might. What happens if 7 is a bull bar closing near its high? Then you get out, right? Do I think we're going a lot lower? Just look at what we've done for the past several hours. Okay. When you look at that, do you feel your anxiety go up? Well, you should, because it looks just as crazy. It goes up a few bars, down a few bars. It just keeps reversing. So, is it a high probability bet that this is not going to reverse? No, it's a high probability bet that it is going to reverse. You know, the market has inertia. It tends to continue to do what it's been doing. And what it's been doing now for 40 bars, 50 bars is making strong moves up and down, and they all reverse. The bears obviously are hoping if they sell here that the market is going to become a bear trend. More likely, we're going to get a reversal. Where will the reversal take place? Well, we should get down to yesterday's close. Yesterday's close is always a magnet. Yesterday's high is a magnet. Yesterday's low is a magnet. So we should get down to yesterday's close. The 60-minute moving average is a magnet. That earlier high on January 30th is a magnet. Over here in the daily chart, that's right here. We're just above that high. I don't have it labeled, but that's the January 30th high. And we're trying to get back below that breakout point and then come down here and turn this thing into a trading range. So let's say you did not sell below 6. You sell the close of 7 or below 7. You're getting pretty close to several support things. The bottom of the expanding triangle, the January 30th high, on 60-minute moving average, yesterday's close. So if you did not short the close of 6 or one tick below 6, I probably would not short down here. I'd wait to see if it breaks below that and then sell down here. The bears who sold here, they're not stupid. They see that every time we've done something bearish, the market went up. Very bearish, it 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 went up. So the bears here will be very quick to get out if it reverses. Now, what happens if it does reverse? Is it possible that this is going to be the low of the day? It's possible, but not likely. 6 is a big enough surprise, especially following 2 other bear bars, that we're probably going to get at least a couple legs sideways to down. So it might be some profit takers around yesterday's close, 79 low, the moving average. So there might be some profit takers there. So we might bounce here. And that because of that, a lot of the bears have sold below 6. Some of them are going to take partial profits at 5 points, which they could do, and had to fall 22 ticks below 6, which it did. So part of this little bounce here is bears taking partial profits. It's 5 points. It's a test of yesterday's close. The bulls might get a higher low, double bottom with 79. Can you buy at the market betting we're at the bottom of the trading range? I would not. And what about buying above 7? 7 would have to be a dramatic bull bar for bulls to buy. You can see the bears are buying back their shorts. Okay, is this bounce mostly bulls buying or mostly bears buying? It's mostly bears buying. We're at a support zone. We tested yesterday's close. It did not collapse through it. Right, the bears were hoping we would do that or that, and this bar was not big enough. So a lot of the bears are buying back shorts. Some get out with 5 points, and some, once it started to bounce, 1, 2 points up, they started to buy back their shorts, trying to make at least a point or 2 profit. They don't want to lose money. Do you have to buy back your shorts? Now you can stay short, stop above 4, and take a chance that if we rally, we'll form a lower high. Just like yesterday, big sell-off. Some bears put a stop up here, and they held short, even though we did all of that, betting that we'd get a new low. Okay, so for the bulls, it's a higher low double bottom 79, a lower low double bottom 1, but it's 4 good-sized bear bars. Most traders are not going to buy above 7. Probably sellers at and above 7. It's still on the sell below 6, and the market is deciding whether it's going to break below all of this support. Remember I said that yesterday it's an average size day, about 40 points, 35 points. It's still possible for today to form an outside down day and go below yesterday's low. We went a little bit above. Anytime you see the market go a little bit above yesterday's high and reverse, you always have to wonder, is it going to go all the way down below yesterday's low and form an outside down day? I think yesterday's low is probably too far. So I think we're probably not going to get below yesterday's low. But if we get, more bear bars, then it becomes more likely that we will get below yesterday's low. But right now it's likely that we will not. I talked about the Globex high that we went above it. Let me put back the Globex chart. We're above the Globex high. We're getting close to the Globex low. So we may go below the Globex low as well. Day session chart. By the way, I talked about this as being a Walmart trade. Reasonable context, you're at support. A second reversal up from below the 60-minute moving average. Potential final flag, parabolic wedge, and a big bull bar closing near its high. So it's reasonable to buy one tick above the high of 16, put a stop one tick below, and place an OCO limit order 20 points above. So you have an order cancel order. So you buy above this, and then you have an order to get out either one tick below or with a limit order 20 points above. And then you go to Walmart and come back in a couple hours. And what you would have discovered is that you would have made your limit order to sell 20 points above your entry. You would have made your 20 points, and you would have been risking, 7 points. You made 20 points. So you made 3 times your risk. And this was an especially good version of it because of what I said about the reasonable buy at the 6th low. There was a 60% chance we would get all the way back to the 6th low. Now, is this the same thing? A sell climax on the open, low of the day? Like yesterday, sell climax on the open, low of the day? Don't know yet, but I do know with 4 consecutive bear bars with reasonably good sized bodies, most bulls are not going to buy the first reversal up. They'll wait for the reversal up to fail, they'll wait for a test back down and then a double bottom, and then look to buy a second reversal up. Sometimes you don't get a second reversal up. Sometimes it goes up, another bar. Then you buy after you see a couple good bull bars closing near their highs. So that way there you do not miss the trick. You have 2 ways to get in. The higher probability is that we're going to get a second leg down and you buy the second reversal up. The lower probability is you wait for 2 or 3 bull bars, especially 2 strong bull bars, and then buy above the second strong bull bar. Like yesterday. Now, some bulls didn't want to buy above 16. They wanted to see 2 bull bars, and they didn't get it until 21. So they bought above 21. At that point, their stop is below 20 or below 16, so they're risking more, but their probability of on the market going at least a little higher was very good, higher. Now, we have 4 bear bars. 3 of them have prominent tails, big tails below. So that means 3 of them, the market went down and went up, went down and went up, went down and went up. So there's some lack of conviction. Bears are not selling relentlessly. They're selling, taking profits. Okay, 5 consecutive bear bars. So, yeah, I still favor lower prices. Is it sell the market at this point? Do you sell the close? Do you sell stop below the low of the prior bar? Now, I think it's better to wait for bars closing near their lows, like 6, and then sell below bars that look like that. So 8, I would not place an order to sell on a stop below 8. And you can see the market went down on 7, up on 7, down on 8, up on 8. So there may be a lot of buyers right here at that 8 low, and we may reverse up again. Would that be a parabolic wedge? Sure. Down on 5, up on 5, down on 7, up on 7, down on 8, up on 8, or down on 1, up on 1. So on a smaller time frame, there's different ways to look at that as a wedge. A purple 1-minute chart here. So we got 3 lows, 1, 2, 3, or 1, 2, 3. So Different computers will see it as a bear channel. In a bear channel, you want to see, you need at least two lows to draw a bear channel. A lot of times the market will test the bottom of the channel, in other words, a third low and reverse. So some computers will say the bear channel is here. Other computers will say the bear channel began here or here, and we're near the bottom of the bear channel. You feel like you're waiting. Whenever you're waiting, there's an increased chance that the market is in our trading range. And you're waiting for evidence that it's not in our trading range. Will we get a bull bar closing near its high? Will we get a big bear bar closing on its low and below support? You think the low of 9 is randomly at that location? No, it's because it's testing that high from last week over here on the daily chart. Okay, we're exactly at that January 30th high. To overlap the high of that bar, and the bulls don't want overlap. They're hoping that we get a gap between the low of this bar and the high of that bar, which would be a bullish thing. This is enough momentum down, and we have a magnet below, a magnet here below. We're probably going below that blue line. The question is, are we going to break strongly below the 60-minute moving average and get all the way back down to yesterday's low? Remember, 60-minute chart, enough of a surprise move down here to expect a second leg sideways to down. So 1, pullback. 2, it's possible that that final bar yesterday is the end of it. It looks more likely that we're going to go more sideways or more down. So we're going to get down to yesterday's low. This is a 60-minute chart. So we should go at least a little bit lower, at least a little bit below the blue line, at least down to the 60-minute moving average, maybe down to the 79 low. The bulls are hoping that this is just a pullback from this rally. And the bears are hoping that this is a double top. We break below the neckline here and fall for a measured move down, which gets us below yesterday's low, and then yesterday becomes an outside down bar on the daily chart. You can see 15-minute chart upside down. An outside bar means it's above the high of the prior bar and below the low of the prior bar. An inside bar is the opposite, right here. Its high is at or below the high of the prior bar. Its low is at or above the low of the prior bar. I forgot to put on that pointer. Let me put up that pointer. That's not what I want. This one I want. That's not what I want. That's not what I want. Let me try again. I'm trying to figure out which of these pointers is the one that I want. I'm going to turn off the screen for a second and try to close out this pointer. And then open it up again. See, I have a small circle and a big circle. I don't want that. I just want the small circle. All right. Sorry about that. I had some help from Brad on how to get the thing that I wanted. All right, so the bulls see this as a higher low double bottom. So it's a double bottom and a higher low, but it's 6 consecutive bear bars. So this is probably a minor reversal, and it's a bad buy signal bar on bar 9. So there are probably bears selling at the 9 high and with limit orders to sell more 5 points above the 9 high, 10 points above the 9 high. Other bears will sell a 50% retracement. So that's the high, that's the low, 50% retracement. It's right around the moving average. It's right around the low of the double bottom. So you'll have limit orders to sell in here, bears to sell. They'll sell with 9 high. They'll place a limit order to sell 5 points higher. Other bears will place a limit order to sell at the double bottom. Other traders will place limit orders to sell a 50% retracement of the sell-off. So there probably are sellers here, just like there were likely to be buyers somewhere down here near the bottom of the range, and sellers up here near the top of the range. What do you do here? If you're a bear, what do you do? Well, you can see a lot of bears scalped out with 5 points. They had a chance here, they bought, and then here over 2 bars, they bought. I think you can be short, but I think you can only be short if your stop is above 4. And can you buy yet? We have 6 consecutive bear bars, and we're in the middle third of a trading range, so I wouldn't buy. I would want, as I said, the market to rally and come down and form a double bottom with 9, or I want to see a series of big bull bars closing near the highs and then I'll buy higher. But right now it's more likely that we're still in a trading range. The bulls are hoping that a lot of computers see it as a parabolic wedge, 1, 2, or 2 and then 3, or 1, 2, or 2 and then 3. Now, can you sell on a stop below 11? It's the same thing buying up here above 3. Do you really want to be buying with a stop at the top of a trading range? Do you really want to be selling with a stop at the bottom of a trading range? So I think most traders right here should be flat and wait to see what happens. Are we going to continue down to yesterday's low, or is this another reversal like yesterday, and will we continue up for the next couple of hours? 6 consecutive bear bars. Right now, it's more likely that we'll get a downside breakout than it is that we'll get an upside breakout. Bears who are short, they get out above 10, a good-sized bull bar. I would not. I think if you're short right now, initially you have a stop up here, and I would be willing to sell more, maybe 5 points or 10 points above 9. I think we're going to get closer to that double bottom. I don't think we'll get close enough for traders to feel like it's been adequately tested. By the way, this low is just about a measure move down below the double bottom. When you have a double bottom, traders look for a break above the neckline, the highest point in between, and then they look for a measured move up, or they look for a break below the double bottom and a measured move down. And today's an example of the measured move down. So that's the neckline of the double bottom, and that's the double bottom. You can see the low is almost exactly at a measured move down, and the 50% retracement is back at those lows. So I think we probably have to get up to those lows. And if we do, something interesting happens. The bears are hoping that this is the sort of a strong bear trend. If we go above that red line, that double bottom, it's probably not a strong bear trend. And therefore, the bears do not want it to go above that red line. So if we get closer to that red line and reverse down, like this, okay, this low did not go below that high. So it's a strong bull trend, we're probably going higher. So the bulls want it to get above that red line. The bears want it not to get above that red line. That would increase the chances that we'll go lower. If we go a little bit above the red line and then reverse down, then instead of a gap, right now there's a gap, 10 high and 5 low. If we go above the red line and reverse down, and the bodies of these bars do not overlap the bodies of these bars, then we have a body gap. So right now we're still always in short since maybe 6 or 7, but not so much sell to close. Traders, we're at a support zone, and traders prefer to sell pullbacks. So if you're a bear, you're either going to be selling the market, selling closes, or you're going to be selling pullbacks. When a bull trend looks like this, you're buying at the market. When it starts to look like this, you buy pullbacks. So you wait for a bull bar, you wait for a pullback, and a bull bar closing near its high, and then buy. And right now, this is a pullback type of trade. Now, if 11 closes near its low, you sell one tick below 11. Can you do that for a scalp? You cannot do that for a scalp. So if you sell one tick below 11, you're selling at the bottom of a trading range at the 60-minute moving average, which is also support. You cannot be selling with a stop at support and hope to scalp out, because you need high probability, and that's low probability. It's like buying above 3 for a scalp. You cannot do that. You're buying at the top of a trading range. Even though you're buying above a big bull bar, the probability is low buying at the top of a trading range. The probability is low selling at the bottom of a range, so selling below 11. So some traders will sell below 11, but only swing traders. It's a low probability sell. I think it's probably better to wait to see if we break strongly below the support, the 79 low of the 60-minute moving average, and then sell more lower. Whenever you have sideways bars, here we have 5 sideways bars, and so you have a tight trading range, and you're being asked to sell at the bottom. It's a low probability trade, so it's okay to sell below 11, put a stop above 10, and hold for a swing. But I would not. I would wait to see if we clearly break below the bottom of the 4-hour trading range and then sell lower, or wait for a rally. Maybe you get a double top with 10 and then sell up here. I don't think we got close enough to that red line for traders to conclude it has been adequately tested. So I think we're going to go up there. Now, this is a second reversal up. I said buying above 9 would be bad. 6 bear bars, first leg down. But you will get traders buying a second reversal up if there's a good buy signal bar. 12, the end of the first hour. And the first hour is an outside down bar. It's a bear bar. We went above the high of the prior hour, and we're now below the low of this hour, so it's outside down. Bears would like this hour to close below the low of the prior hour, and then they hope that it's the start of a bear trend day, a lower high needs trend reversal. Bull trend, strong breakout below the tight bull channel, and then a lower high. Another couple minutes before the 60-minute bar closes. And as I said, it would be good for the bears if they can get an outside down bar closing near its low. Here, you have an outside down bar, close below the low of the prior bar, you expect lower prices, right? Outside down bar, closing below the low of the prior bar, you'd expect lower prices down for a couple more hours. And the bulls don't want that, so the bulls will try to get bar 12 to close above the low of the prior hour, bar 79. And the bulls really would like 12 to look like 16 from yesterday. They would like a big bull bar closing near its high, and if they get it, it would be a reasonable buy. The bears will exit and bulls will buy, taking a chance it's the low of the day. But 6 consecutive bear bars, at the moment, a bull trend day is unlikely. We're probably not going above the high of bar 4 today. What happens if we get 3 big bull bars, 4 big bull bars? Then we'll probably go above the high of 4. Right now, we're probably not going above. We probably have seen the high of the day. By the close of bar 12, right here, 70% chance we've seen either the high or low of the day. The bulls want 12 to close on its high, and then they hope 12 becomes the low of the day. And the bears right now are hoping that the start of this 6 consecutive bear bars, the 4 high remains the high of the day. 70% chance we've seen either the high or low of the day. At the moment, more likely 4 will remain the high for the rest of the day. Even if we rally up here, chances are 4 is going to remain the high of the day. Okay, you can see the fight over the appearance of bar 12. Can the bulls turn it into a bar 16 and the sort of a credible rally, make it a good buy signal bar? Can the bears get 12 to close at or below 79 and then have an outside down bar on the 60-minute chart closing at or below the low of the prior bar? That would increase the chances that we're going lower. Trading ranges don't last forever. There's always going to be a breakout up or down. The bears are hoping that the breakout below the trading range succeeds. They're hoping, 12 has already broken below the range, and they're hoping that we go lower. And the bulls broke above the top of the range and did not go higher, reversed down. Okay, so this happens a lot, where you get almost what you want. On the 60-minute chart, we have an outside down bar above the high of the prior bar, below the low of the prior bar, but the close is above the low of the bar. So that's more trading range behavior than it is bearish behavior. And on the 5-minute chart, we have a parabolic wedge, and we have a bull bar closing near its high, but the tail is fairly conspicuous. Bears, I'd get out above 12. Some bulls will buy one tick above 12, put a stop, one tick below 12, which is okay, but if you do it, I would only do it trading small. And when I talk about trading small, I talk about trading 20% of your normal position size. So if you normally trade one E-mini, 20% is 2 micro E-minis. So you buy 2 micro E-minis and put a stop below 12, or you place a limit order to buy more at the low of 12. Otherwise, I would wait for more signs that the bulls are in control. What are more signs? It means more bull bars, big bull bars closing near their highs, consecutive bull bars. So the more of that we get, the more likely we'll go up. You can always look at the 15-minute chart. Look at yesterday, the low. Okay, it's around a 50% retracement of that, and a bull bar closing near its high. Here, a big bear bar closing near its low, room to the 60-minute moving average. Reasonable to sell below that 15-minute bar. Reasonable to buy above this 15-minute bar. So the bears who sold below that bar, they made a little bit of money, but not much. The bulls who bought above this bar got their 20 points. Most days have a decent signal bar on the 15-minute chart, either long or short, sometimes both. And today, this 15-minute bar has a big tail on top, and that's really not what the bulls want. So probably not a lot of buyers above that bar. But if this current bar is a big bull bar closing on its high, you will get bulls buying above it. Remember I said we're probably going above this red line. Now, why did I say that? Let's look at what we've been doing. Okay? This is the past 40 or 50 bars. And there's no question, is it a trading range or a trend? It's a trading range. And in a trading range, you have to assume that traders are going to be disappointed. The bulls are going to be disappointed at the top. The bears are going to be disappointed at the bottom. The bears are hoping that we have a gap below those lows and that this round is a bear flag and that we're going to get a big bear trend. And if we don't get a gap, in other words, if we go above that red line, the bears will be disappointed. And in trading ranges, traders tend to be disappointed. Currently we're in a trading range, so chances are the bears are going to be disappointed, and that means chances are we're going above that red line. What happens at 13 is a big bear bar closing near its low. Then we have a low 2 bear flag or a double top bear flag, 10, and bears will sell again. But they'll want 13 to be a very good-looking bear bar. They'll want a pretty good-sized body, at least 2 or 3 points tall, and they'll want the bar to close near its low. Why are the bears not selling here? Well, it's a second reversal up from the bottom of a trading range, and then from other support, the January 30th high and the 60-minute moving average. So the bears are not willing. They're seeing it reverse up twice. So now they don't want to sell near the low. They only want to sell rallies. So they'll look for a rally and then a reversal down and then sell. So right now there are not a lot of bears selling. And the bulls, hoping this is the low of the day, another leg in the expanding triangle. But two problems. One is the tail on the top of 12 is bigger than they want relative to the size of the body. And it's 6 consecutive bear bars here. So pretty relentless selling. Now we've had consecutive bull bars. Second one big, closing near its high. Is it by the close yet? No, we're right below a lot of resistance. As I said, I think we're going at least one tick above that red line, but not necessarily much higher. I think at the moment we're probably not going to go to a new high. So a small position above 12, they're still long. Stop below 12. Will they buy more above 13? If you're scaling in, if you're trading small and you're scaling in, usually I prefer the second or third or fourth entry to be at least the size of a scalp above the first. So if you bought one tick above 12 and you're looking to buy again, you look to buy at least 5 points above 12 and above a bull bar closing near its high. Double bottom 9, 12, the highest point in between 10, that's the neckline. And we just are going above the neckline, and the bulls want a measured move up. Okay. And there are two ways to do a measured move with the double bottom. You can take the higher of the two lows or the lower of the two lows. And obviously, if you take the higher of the two lows, the measured move is here. If you take the lower, the measured move is a little bit higher. So usually when I'm looking for a measured move from a double bottom, I start by looking at the measured move from the higher of the two lows. If it goes above it, then I move this line down to here, and I look at the new target. Remember, right now, we're probably not going to go above the high of the day. So right now, 60% chance we've seen the high of the day. But if we get 4, 5, 6 bull bars, then we probably will go above the high of the day. So the probabilities change. Every new tick is more information, and it changes the probabilities. Tick is more information, and it changes the probabilities. Bulls want closes above resistance. They want to close above the neckline of the double bottom 10. Close above the moving average. They want to close above this double bottom. What happens if we get two good-sized bull bars, both closing above the moving average, and the body of the second bar is completely above the moving average? Then we're probably going to go above the high of the day. Moving average. Then we're probably going to go above the high of the day. These slides are the PowerPoints in my encyclopedia. Examples of bull breakouts. In general, here we go to trading range. Traders are looking for a breakout that has consecutive bull bars, preferably both closing near their highs, with decent sized bull bodies. And if the body of the second bar, so we have 2-bar breakout, 1 and 2, if the body of the second bar is completely above the resistance, for example, above the moving average, above the trading range, you're probably going to get some kind of a measured move up. So here, we have consecutive bull bars, both closing above the moving average, both closing above the trading range, and the body of the second bar is completely above the trading range and above the moving average. So we're probably going to get a measured move up. So from the bottom of the range to the top of the range, measured move would be about there. Consecutive bull bars closing near their highs above the moving average. The body of the second bar completely above the moving average. We're probably going at least a little higher. Consecutive bull bars closing near their highs, closing above the 20-bar exponential moving average. The body of the second bar completely above. We're probably going at least a little higher. Trading range, consecutive bull bars closing above the moving average, closing above the trading range resistance, and the body of the second bar completely above the resistance of the top of the range and the moving average. We're probably going at least a little higher. And here we don't even have a single bull bar closing above the moving average or above the neckline or above the double bottom up there. So, it's not yet by the close. For the bears, a higher high double top 10, but 3 consecutive bull bars. So probably buyers at the 14 low and 5 points lower, maybe a 50% retracement. Can you short this? No, I would not. You got a surprisingly good thing for the bulls, 3 bull bars. You've got a wedge bottom, which typically will have 2 legs up. You have a surprisingly strong rally. That typically will have 2 legs up. So we're probably going to get a second leg up. So that means the first reversal down below 14 is probably not going to go below 12. So for the bulls, they buy the 14 low with limit orders, stop below 12. The stop order bulls who bought above 12 or above 13 do not exit here. Their stop is below 12. But if we get a bear bar closing near its low, 15 or 16, then the bulls will get out. Confusing. And whenever there's confusion, the market is probably in a trading range. When traders are confused, they're hesitant to buy too high, they're hesitant to sell too low, they tend to trade more with limit orders. When the market goes up, they sell. When it goes down, they buy. And they tend to take quick profits because they are not confident that the market is going to go very far in one direction. Are we still always in short? Yeah, I think so. Now, I said we were going to go above that red line. I said we probably would because we're in the trading range. I also said 10 was not close enough to that line for traders to believe the line was adequately tested. 14 is close enough to that line for traders to think, yep, it's been tested. But 14 is also a bad sell signal bar. So while the context is good, a breakout test of the 5 low, a 50% retracement, the 3 bull bars are bad. So better to wait. Now, what about the bulls who bought above 12 or above 13? I think they need to stop below 12, or they buy more at the 12 low and put a stop the size of a scalp below that. So 20 or 22 ticks below that. Might be forming another expanding triangle on a smaller time frame chart. We went down, we went up, we went down, we went up, we went down, we went up. So in a smaller time frame chart, like 1 minute chart, it's an expanding triangle. Low, high, more low, more high, more low, more high. Sometimes the market gets in the mood to create a certain pattern repeatedly. Sometimes it's a bunch of wedges. Sometimes it's a bunch of contracting triangles. Sometimes it's double tops and double bottoms. And the past few days, it's been a lot of expanding triangles. Can you buy above 15? It's the same as buying above 12 or 13. Not much price, not much difference, and it's at resistance, so I would not buy above 15. If you sell below 15, if it's a bear bar closing near its low, you can only do it for a swing. I think most traders here are waiting for more evidence that we're going to trend down or that we're going to trend up. So, I would not, not get upset. Whenever you feel anxious that, it's going up, no, it's going down. Whenever it's not clear, that's instead of getting upset by that, you should view it as your radar telling you that the market's in a trading range and it's better to do nothing. Wait until things become clear. Look at the open. First 5 bars, a lot of reversals and sideways. And then here, bar 7 to 15. So you got 8 or 9 bars, a lot of reversals, trading range behavior. So the market was only clear briefly, 6, maybe 7. And so far, trading range day. For the bulls, they're hoping 12 is the low of the day. 15 is therefore a pullback in what they hope is a bull trend. But it's a bear bar at the moving average and at the top of a 10-bar high trading range. So not a lot of buyers above 15. And not a lot of sellers below 14. Better to wait for things to become clear. You want a good sell signal bar near the top. You want a good buy signal bar near the bottom. Or you want a strong bull breakout and then buy. Or a strong bear breakout and then sell. Otherwise, wait. Buy signal bar 15. Bears hoping that they get a bear bar closing near its low 16, and they don't want the bar to get too big because they don't want to be selling too low in the trading range. I talk about this as being a wedge, down on 8, up on 8, and then up on 10 and up on 14. This is a reasonable swing sell. So if you're long, I would get out below 16. And if you want, you can short. But you cannot short for a scalp. Chances are you're not going to make a swing trade out of this. But it's a reasonable swing trade. We've got a couple legs up, 14, second leg up, 16. We have a bear bar closing near its low. Again, just like buying above 12, trade small. Selling below 16, trade small. You know, you're pretty low you're in the middle of a trading range. The bulls are hoping that 17 is a pullback from 12, 13, 14. Bears are hoping that 16 is the start of a bear trend. Market's deciding which will it be. Can you get long above 17? If 17 closes at above the moving average, I think it's an okay buy. Best choice, wait for things to become more clear. If I had to do anything at this moment, I'd be short right now, stop below 16. But if 17 is a bull bar, I'd get out above 17. And if it's a bull bar closing at above the moving average, it's a reasonable swing buy. 17 bars today, only bar 6 was clear. Everything else, low probability. What about the Walmart bulls? Can they be long right here? One take above 12, stop below 12, put a protective stop below 12, and put a limit order 20 points higher, and go to Walmart. They can be, but I didn't think 12 was a good enough Walmart buy. Is 16 a good enough Walmart sell? It's kind of the same as buying above 12, a little bit better because of all the bear bars that we had earlier. So it's slightly more bearish than bullish. We're above the moving average. We have a bear bar closing near its low, below the moving average. But we're in the middle of a trading range right above several support things here. So best choice, wait. Can you buy the 16 low, betting that it's a bad sell? Well, limit order scalpers will look for anything bullish and they'll sell it. They'll look for anything bearish and they'll buy it. So bears sold the 12 high, bullish, they sold more 5 points higher. Reversal down, they bought the 14 low, they'll buy more 14, they'll buy more 5 points lower. The bears, a high one, bar 15, the bears sold it. See how the market, you see the market deciding what to do with 17. Is it going to be a good entry bar for the bears? Is it going to be a big bear bar closing near its low? Or is it going to be a good buy signal bar for the bulls, hoping that 12 is the low of the day and that this is just a two-legged pullback? Or is it going to be not a good, is it going to be a neutral bar? a bar with a big tail on the top and a big tail on the bottom. Bulls want 17 to close at or above the moving average. While it closed near its high, good, it did not close above the moving average. So that reduces the number of bulls who are buying at the market. A close at or above the moving average would have attracted more bulls. The bears are trying to stop it from going above 16, the top of their sell signal bar. But it's a trading range, and trading ranges, you have to assume everybody's going to be disappointed. So if it goes above 16, the bears will be disappointed. That's what it probably will do. Consecutive bull bars closing above the moving average, closing near their highs, with the second body completely above the moving average. That would be buy the market, looking for a measured move up. Gets us up to the high of the day, maybe a little bit higher. And you saw at the market, betting double top 15. I think most traders should wait. We're still on the sell below 16. We're on the buy above 15, the buy above 12. But we need more information. It's important that 14 did not close above the moving average. 17 did not close at or above the moving average. The opposite of this, we got one close below the moving average. That was it. Going below the moving average, but could not close below it. So the market kept trying to go down, unable, and went the other way. Here, the market's repeatedly trying to go up. And if it fails to break strongly above the moving average, the bulls will stop buying at this price and they'll only buy lower. So if it tries to do something repeatedly and fails, it then usually tries to do the opposite. In here, arguably 11 is a decent sell signal bar, 16 a decent sell signal bar, 12, 17 good buy signal bars. It's really 50-50 right now. Maybe slightly more bearish because we're below the moving average, but it's really a 50-50 market right here. The bears want a good sell signal bar reversing down from the top. 18 is not good enough. The bulls want a good bull bar reversing up from the bottom. 12 is okay, but unable to close above the moving average 17. So it's still deciding. It's still basically 50-50. The more sideways trading that we have, the less likely we're going to get a big trend today. And now we've had 19 bars, and we've really only had a clear trending on bar 6, maybe bar 7. So mostly trading range trading today reduces the chances that the market will become strongly bearish or strongly bullish. Theoretically, the stop for the bears is above 16. Stop for the bulls below 17 or 12. The bulls were unable to run the stops. They were unable to get above 16, so that's good for the bears. And the bears are trying to run the stops on the bulls, get below 17, get below 12. Bulls unable to get a close above the moving average. You call it a triangle. We have a lower high. We have two higher lows. Well, that's breakout mode, but we're already in breakout mode. We're in a trading range. Slightly more bearish than bullish, but it's not like 60%. It's more like 52% bearish, 48% bullish. Best choice, flat. Can you sell at the market and put a stop above 18? Yeah. Can you buy at the market and put a stop below 17 or below 12? Yeah. But I think better to wait. I said the bears will exit one tick above their sell signal bar 16. especially with a double top 18, and you buy on a stop 1 tick above the double top, arguing that the bears will get out and you'll get some buying from the bears. You probably can. I still think it's better to wait to see if we start to get one or more bull closes above the moving average. Likewise, can you sell on a stop below 17? I think that's less good because some bulls will have their stop below 12, the original buy signal bar. Okay, so it looks like we're breaking above the double top. So bears will exit and you'll get some bulls buying here. So we have a possible breakout here. Bears are hoping that this is all a pullback from this and that we get a good sell signal bar and we go down. And bulls are hoping that this is a sell climax and a small pullback bull trend that lasts all day. Can the bulls get bull bars closing on their highs above resistance, above 16, above 14, above the moving average? And the more they do that, the more likely we'll go back to the high of the day. The less they do that, the more likely this is just a bull leg and a trading range. Big sell-off on the open, 50% chance it will reverse, 50% chance it will lead to a bear trend. A lot of times when you get a sell climax on the open, a whole bunch of bear bars, you get a reversal for the remainder of the day, like yesterday. And every time it goes down, traders buy. Today we have so much trading range trading that I suspect it'll be more like this: big sell climax, second sell climax, and I think we're going to be mostly sideways today. Bulls are hoping that we reverse up to the high of the day. Here we had a lot of trading range trading, but we also had many bull bars, big bull bars, closing near their highs and above the moving average. And then consecutive bull bars closing above the moving average. The body of the second bar completely above the moving average. So you get more bulls willing to buy, taking a chance. We're going to trend up for several hours. Small sell climax and then small pullback bull trend coming far above the open. Usually, if you have a pretty strong sell-off on the open, like here and like today, if you get to a new high, it doesn't go far above. We went somewhat above the old high, but not a lot above. Big sell-off on the open, reversal up. Usually does not get far above the earlier high. Here we did not even go above that earlier high. Pretty strong sell-off like today, and good reversal up, but did not get that much above the earlier high. Kind of like today, a lot of bars with prominent tails, a lot of sideways bars. And it went higher for several hours and made a new high, but not far above the old high. The market crashed on the open and basically sideways for 3 hours, 4 hours. But it was also a small pullback bull trend all day. Did not get above the earlier high. Small pullback bull trend all day and went above the earlier high, but not all that much. Couple legs down, kept trying to reverse up, good looking bull bars, but stayed sideways for a lot of hours. Got a little bit of a breakout, but not much more. This is, I think, the kind of thing today is likely to do. It might go up a little bit, might go down a little bit, but it's probably not going to go very far either way. A lot of prominent tails. But you can see a lot of sideways trading. Most of the day was sideways trading. You got a few bars up at the end of the day, but really hard to buy here with only 4 bars left of the day. So you can kind of ignore that. And this is, what we got. 20, unable to close above the moving average. unable to break above the double bottom. And now we have 3 clear legs up, 1, 2, and 3. So now a more obvious wedge bear flag, but a bad sell signal bar 20. Bears, they might sell below 21 if it closes near its low. Also 21, it's a multiple of 3, and therefore it corresponds to a 15-minute bar closing. There's a 15-minute chart. Let me straighten that out. The bears are hoping that this is the start of a bear trend, 15-minute chart, but they want to get a bear bar closing near its low. The bar closes in about a minute, and the more this bar closes near its low, the more traders will sell below its low. And for it to close near its low, they need 21 to close near its low. The 15-minute bar opened with 19. It finishes with 21. So the bears want 21 to close at or near its low. On the 5-minute chart, they'll sell below 21. On the 15-minute chart, they'll sell below the low of the 3 bars, which is either 19 or 21. Lots and lots of reversals. Now, are the bulls still long if they bought above 12 or if they bought above 17? Yeah, it still has not gone below the buy signal bar 17 or below the buy signal bar 12. The bears did not get what they want. The 15-minute bar is a bad sell signal bar. A small bear body, a prominent tail, 4 sideways or 6 sideways bars. So right now we're still on the buy above 17. We're still on the buy above 12. We're no longer on the sell below 16. But we're not able to get closes above the moving average. So yeah, you could buy at the market and put a stop below 17 or below 12. I think it's better to wait until it becomes clearly bullish, or wait to see if we can buy a reversal up from lower down. And for the bears, I think they're out of shorts. If they sold below 11, we went above 10, the top of that leg. If they sold below 16, we went above 16, we went above 14. So I think there's no reason to be swing trading for a short at this point. So if you're a swing trader, you're either long or flat. Unable to close above the moving average. Yesterday, unable to close below it, and eventually we accelerated up. The bears are hoping that we continue to be unable to close above the moving average, and then the bulls give up and we collapse down. When the market is trading like this, don't feel like you have to take trades. This is all limit order scalping. Traders buying below things, buy below the 14 low, buy below 16, buy below a prior low 15, buy below 20, sell above things, sell above a prior high, above 10, above 14, sell above buy signal bars, especially bear bars 15, 19. But the range is so small, it's difficult to make even 5 points with limit order scalping. Better to wait. And even once we do get a good, convincing start of a trend up or down, with all of this trading range trading, we're probably not going to have a big trend day today. Breakout mode, that means that the market's sideways, and it has both a double top and a double bottom. Here we got a double bottom, 9 and 12, double top here, another double top here, double bottoms here, 17, 19, 19, 21. And better to wait for a clear breakout, up or down, or look to sell a reversal down from the top, or a reversal down from the reversal up from the bottom. Do I think we're going above that red line? Yes, I still think we're going above that red line. Can you buy here above 23, the first close above the moving average? The math is not great. You're buying at the top of the trading range, and yeah, we're going to go above the red line, but are we going to go a lot above it? I don't know that we're going to go a lot above it. So remember what I said a couple times today. The bulls wanting a breakout, a lot of the bulls will wait for a couple of bull bars closing near their highs, consecutive bull bars, both closing above the moving average, and the body of the second bull bar completely above the moving average. So the bulls want 23 to have a decent sized body to close near its high and for its body to be completely above the moving average. If they get that, then you'll start to get bulls buying the close, betting that we'll get a measured move up. Measured move up, based upon the height of the range, gets us to a new high of the day. Bears are hoping 22 is a trap, trapping bulls into a bad long. But the bears need more than just a bear bar. They need to get it closed back below the moving average. Right now, it's always in long. Still, it's probably always in long since 12, maybe since 17. But the bulls need to get a clear breakout. Remember I said we would go at least a tick above that double bottom because we're in a trading range. And when the market's in a trading range, it usually disappoints traders. And the bears did not want it to go above that red line. Therefore, it was likely to go above the red line. Sell below 23. I think the bears need a very strong bear bar for the close at or below the moving average. And the minimum that the bulls need is no bear body. So if it's a perfect doji, that favors the bulls. That's the minimum confirmation of a successful bull breakout. But the bears need at least a one-tick bear body to keep the confusion going. The bulls need at least a perfect doji, no bear body, to increase the clarity, increase the chances we're going up. And the bigger the bull body, 23, the more likely this is the sort of a swing up. If 23 can close on its high above 20 and above that red line, its body will be completely above the moving average. You will get bulls buying the market and buying above it. This is bar 23. 24 is a multiple of 12, and it represents the close of the hour. And the bulls are hoping that the 60-minute bar is a bull bar. So they're hoping that the 2 legs down are 1, pull back 2. So they're hoping it's more 2 legs sideways than down. But they need a good buy signal bar. They want the hour to close near its high. Remember, the minimum the bulls want with 23 is no bear body. If they get it, you will get bulls buying the close of 23, stop below 21. The more it closes on its high, the more bulls will buy at the market and bet that we're going to go up for a measured move. So if 23 closes far above 20 and on its high, if it closes up here, traders will wonder if it's a measuring gap like yesterday. Had a bear flag, and we broke above it. We had a bull follow-through bar, and we went up for a measured move. We went up. 30 seconds remaining to the bar. The more it closes on its high, the more it closes above the red line, the more it closes above 20, the more bulls will buy at the market or buy with the stop one tick above its high. Stop below 21 or stop below 17. So stop somewhere in this area. And the bears do not want that. Can the bears stop it? If the bears cannot stop it, that's further evidence that we're probably going to go higher. Okay? Very good for the bulls. So let's buy the market, buy the close. What happens if 24 is a bear bar closing near its low? Bulls will get out. Bears might short. But right now, the odds are we're going to go up, possibly for a measured move. Now, is it a failed breakout if 24 closes near its low? In general, if you buy a breakout and you get a bear bar closing near its low, it's better to get out. Can you go short below 24? Betting on a failed breakout. We're in a bull channel. I personally would not take the short, but I think it's reasonable to exit longs if you get a bear bar closing in its lower third, lower half or so. You can always buy it again if we get another bull bar within a bar or two. Right now, it's always in long, and probably 60% chance we're going to go higher. Maybe only a measure move based upon this trading range, possibly a measure move based upon all of this. But chances are we're going to go at least a little bit more. Now, the bulls have bought above 22 or above 23. They can get out. If you bought the 23 close or one tick above 23, the market's letting you out right now with a small loss. Are a lot of bulls going to get out with that small loss? Or are they going to hold long? Are they going to buy more? Okay. Not a good follow-through bar. Also not a good sell signal bar. So I don't think, I think the bulls will not get out below 24. I think the bears will not short below 24. The bulls right now still have a stop, maybe below 17, maybe a couple ticks below 17 to allow for this being a bull leg in a trading range, and then a bear leg in a trading range, and then double bottom at 17. And the bears is just not good enough to sell. Bulls are hoping this is a small pullback bull trend, and they're hoping that, we just keep getting every reversal is a small pullback. Here, 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 here. And if you go below 24, they hope it's a small pullback. Can this be the start of a big bull trend day? Again, with so many bars sideways with big tails, it reduces the chances that we'll have a big trend in either direction. Right now, it's slightly more bullish than bearish, but it's really not strongly bullish. So I'd say it's probably not going to be a big trend day up or down. Can we break above 5,000? Remember I said I thought we had a good chance of breaking above 5,000 this week. I don't think we'll get there today. Too much sideways trading, and we only have 55 bars left in the day, which is not a lot. And today, so far, has a lot of trading range trading. So I don't think we'll go 30 points and 50 bars. Disappointed bulls, they can get out, break even if they want. If enough do, we'll reverse down again on 25. If we do not reverse down on 25, that means that most of the bulls are not exiting, they're holding long. So that would be bullish. Back to waiting. Sideways bars, big tails, waiting. And waiting is trading range trading. So it's slightly more bullish than bearish, but it's not strongly bullish yet. If 24 looked like 23, it would be considerably more bullish. Well, it did not. The 22 high is 496 and a quarter. 22 ticks above that is 471.75. And obviously the bulls that bought above 22 have not even been able to scalp out for 5 points yet. So not very bullish. You got a good buy setup, good follow through 23, and 2 bars later, the bulls have been unable to make a scalp. That is discouraging other bulls from buying. Right? If you're seeing that it's easy for bulls to make money, you want to buy. If you're seeing it's difficult for bulls to make money, you don't want to buy. And that's what's taking place here. The bulls look at this and say, it's bullish, but it's not even going up enough for a scalp. If you bought above 17, you're finally able to make 5 points. But it took, 8 bars, 7 bars to make 5 points. That's not bullish. Bullish, you buy, and the very next bar, the bar you enter on, you make your 5 points. Bearish, if you sell, close at 6, you make your 5 points on the next bar. Okay, now we got a bear bar closing near its low. More bulls will exit below 25. Is it good enough to short? I don't think it's good enough to short. I still think we're probably going to go higher, but I think it's a problem for the bulls. You have to get out. It's a small pullback bull trend, so 25 is kind of like 16. You don't have to get out. It's okay to get out. If you do get out, you can wait for a bull bar closing in its high, like 17, and buy again. But right now, it's not bearish enough to short. And for the bulls, it's really not all that good. Bullish, but not strongly bullish. Bulls are hoping that these reversals are tests of this double top. And they hope that we continue up. Like yesterday, 35 was a test of 29 and 26. But look at that. We had 4 or 5 bull bars before we got the test. And here we just got the breakout and immediately reversing down. So much less bullish. In general, anytime there's a breakout up or down, my immediate assumption is 50% chance it'll succeed, 50% chance it'll fail. And the more bullish it is, the higher the probability. I thought with the close of 23, 60% chance that it would succeed, but that's 40% chance it'll fail. Bar 6, I thought it was 60% chance it would succeed, and it did. We may be coming down to that 17 low, trying to form a double bottom. A lot of times when the market reverses up, the first leg up is disappointing, and the market gets down to the first pullback and forms a double bottom. So the market might be doing that. I'm not calling it a major trend reversal, but a lot of times you get a rally, the bulls are disappointed, you get some bear bars, and the market comes down and forms a double bottom. It's rarely perfect. Here it's slightly higher, so it's a slightly higher low double bottom. And then the market became more bullish. Tried to break out, reversed down, higher low double bottom. Here, this is slightly lower low. So the double bottom is a higher low major trend reversal. And the second low is slightly below the first low. So it's a double bottom, a lower low double bottom, but the double bottom is a higher low major trend reversal. Try to get a double bottom here, try it here. You can see not a lot of bears selling below 25. They did not even make a scalp. And some bulls bought at the moving average. The moving average was resistance for 10 bars, and the bulls are hoping it's support. And we were unable to, we closed the gap. We're back below 20 high, back below 14 high. But these bodies, we were holding above the bodies. So on a line chart, there's no overlap. See, on the line chart, we still have a gap between that low and these highs, and it's bullish. How bullish can 25 be? The more it closes on its high, the bigger the bull body, the more bulls will buy above it. And if there's a bear body, most bulls will not buy above. And for the bears were sold below 24. It went down several points, and it could not even make a scalp. So there were so many buyers at the moving average and just below. So it's a bad entry bar for the bears who sold below 25. It's a bad buy signal bar for the bulls who are hoping this is a small pullback bull trend. So what do you do here? You wait. Can you be short? I personally would not be short. Can you be long? As I said, a bear bar closing near is low, a failed breakout. I think it's better to exit longs and then wait for a bull bar closing near its high and then buy again. Now, if we start to go down, at some point the bears have to get short. What do the bears need to see? Bear bars closing near their lows, consecutive bear bars. And then a really important thing is, we closed the gap here. We had a gap between the 14 high and the 5 low, and we closed it. And now we have a gap between, okay, we broke above all this stuff. We closed above it, we closed more above it, but we still have a gap between the bodies. These bodies do not overlap these bodies. So there's a body gap. In a line chart, you can see there's still a gap. It's hard to see, but that low currently is above these highs, that red line. So we have a body gap, which is bullish. And if 27 closes below that red line, there's no longer a body gap. And that means on the line chart, this line will overlap these highs. And that makes the chart much less bullish. Will overlap these highs. And that makes the chart much less bullish. Bears are hoping 25 is the resumption of the bear trend, and bulls are hoping that this is simply forming a trading range. If it is, the bottom of the range will probably be around here, 17 low, maybe a little bit below it. Can you put, if you're long, can you put your stop below 21? No, that's dumb. The market, the bottom is either the 17 low or the 13 low. So if you're long, and if you're putting a stop below 21, do not do that. Instead, put the stop maybe a tick or two below 13, the bottom of this trading range. Whenever the market's in a weak channel like this, higher, low, and bull breakout, a lot of beginners, they're afraid to lose much money, and they put their stop as close to the market as possible, like below 22 or below 21 or below 19. And you can't do that. You have to put it below the bottom of the range, below 17 or below 13 or even below 12. So if you're still holding long, do not put your stop below 21. So you do not put your stop below that bar, You might put it below there. And if you get stopped out, you wait for a bull bar or 2 or 3 bull bars and then buy. So if you bought above that, do not put your stop below that. You put your stop below the trading range. If you buy here, if you put your stop here, a tight bear channel, I think you'd put your stop below that. And if it reverses up, you buy more above the bull bar closing near its high. If you bought above this, do you put your stop below it? No, you put your stop below that or a little bit below that. And if it reverses up, then buy more. If you buy above this, do you put your stop below that? No, you put your stop below that or below that. If you're long for any reason, you put your stop below that possible trading range. So I would put it below the bottom of the range here. Since there aren't a lot of stops below 21, from beginners and stupid computers or stupid traders, and below 19, and since we're in a trading range, we're probably going below 21, probably going below 19. But we're still in a trading range, so there probably will be buyers somewhere in this area. 6 to 17 low, a little bit below. Now, after bar 18, 80% of the time we've seen either the high or low of the day. So right now it's more than 80%. Here's bar 18, and we're 10 bars later. So probably 90% chance either this will remain the high of the day or this will remain the low of the day. It's possible both could be true. It's possible that this is the high and this is the low. Remember I said earlier that I thought when we were down here that this would probably remain the high of the day. It's still possible that this could also be the low of the day. More and more bulls giving up, realizing that it's going to get down to these lows. And high frequency trading computers are selling, knowing it's going to go below at least the 21 low, and probably below the 19 low. Is this bearish enough for traders to sell the market? We're still in the trading range, even though we're below all of these lows. We're still in the trading range. The bears are hoping this is going to be leg one, leg two. Let me get rid of that. The bears are hoping it's leg one, pull back to leg two. Okay, we're closing the body gap. And that's part of the reason why 28 is as big as it is. A lot of the computers see that there's no longer a gap, there's no longer a body gap, and therefore there's no longer a bull trend. And so a lot of the bulls who are hoping for a bull trend are giving up on 28. This is mostly bulls giving up because of the overlap. They're betting that 28 is going to close below the red line, and that will have a body gap. It's no longer bullish. Right? The attempt at the bull trend has ended. But is it bearish? No, I think it's probably more neutral. The bears want to get consecutive closes below the moving average, which they have, 27, 28. They want the body of the second bar completely below the moving average, which they probably have 28, but we're still at the bottom of the trading range. So I think you'll get fewer bears willing to sell yet. I want to see more of a strong breakout. Bears are sold below 25. So far, even with these big bars, they've only made 5 points. The bars look big, but they're really not all that big. Now, the bulls, they want a reversal, a higher or low major trend reversal. But they'll need a very good bull bar 29 to attract buyers. And for the bears, they know we're at the bottom of the trading range, so a lot of them are scalping out. They were hoping that we were going to collapse below the range and they would hold short, but they can see the pause. Stop for the bears if they're short above 24. I said that I thought 4 would probably remain the high of the day, but right now the market is probably not going to go above 24. The bears are hoping that this is a spike, a pullback, and that will channel down for the rest of the day. The bulls are hoping that it's a sell-off and that we continue sideways for the rest of the day. Which is more likely? As I said, we've had so much trading range trading today. I think the odds are against a strong trend day. So even if we go down, I don't think we're going to go very far down unless we start to get more big bear bars closing the end at lows. Until we get that, chances are we're going to be mostly sideways. 60-minute chart, you can see basically sideways for 7 hours here, 7 sideways bars. The bears want to get down here, maybe a little bit below. So 1, pull back 2. And the bulls are hoping that this is a resumption of the bull trend and that we form a higher low and then continue up. This is big enough down, so I think we'll probably come down here, tomorrow or the next day. Now, if a bear, what does a bear do? If he sold below 25 or below 28, the opposite of what the bulls did with 25. If 29 is a bull bar closing near its high, I think the bears should get out. And will the bulls buy? Well, it's kind of like here we had 6 consecutive bear bars. Here we have 5 consecutive bear bars. The bulls are hoping for a higher low major trend reversal. But after 5 consecutive bear bars, if we do reverse up 29, it'll probably be minor. So I think most bulls will not buy. They'll wait to see if we get 2 or 3 bull bars, or they'll wait to see if we go up a little bit, come down a little bit, and form a double bottom. You have to get out of shorts above 29. I would. I don't think you have to. You can keep a stop above 24. But I would get out of shorts and then wait for another bear bar, 30 or 31 or 32, and then sell again. And for the bulls, it's enough of a surprise, 28 plus 5 consecutive bear bars. I would wait for a micro double bottom before buying, or wait for a very strong reversal up and then buy. So not a very good buy above 29. You don't have to get out of shorts. You can. Remember, we're still in a trading range, and it's possible that the day stays a trading range day. And when you have a trading range day, there are often strong legs up or down that reverse. And if the legs are strong, you wait for a second reversal. So a strong move down to 9, and then second reversal up on 12. And then here, it's really just a failed breakout above the double top. And here, the bulls are hoping it's a failed breakout below a wedge bear flag. But I think the 4 bear bars, the 5 bear bars, and the bigger bear bar here, the tail here, I'm not going to buy above 29. Confusion, bad follow through, disappointment, all signs of trading range trading. And that's what we still have. The bulls made a good attempt, 23, but failed. The bears are making an attempt here, but they have not done enough yet to convince traders that it's worth selling here. If the bears are lucky, we'll go sideways to up for 3 bars, 5 bars, 6 bars, and get a good sell signal bar at the moving average. And that would be a reasonable sell. They don't want to sell too far below the moving average because the market is in a trading range. So you don't want to sell below the average price when the market is average. You want to sell, you want to sell higher. You don't want to sell near the low. The bear inside bar closing near its low, but at the bottom of the trading range and just above the 60-minute moving average. Might be more buyers than sellers below. Right now, I think we're back to always in short since 28. So you can sell, but if you sell, I would use a wide stop, which means I would trade small. You can add on if it starts to go down in a trend. But basically 50-50. You have a strong reversal down, 5 bear bars, a big bear bar, 28. You have a good sell signal bar, but you're at the bottom of the trading range and far below the moving average. So might be more buyers than sellers, 28 low. Bulls trying to get a micro double bottom and then a leg up. And if they do get a leg up, bears will sell if it fails at the moving average and around a 50% retracement of that. But it looks like more trading range trading. Until there's an obvious trend up or down, you got to bet that the day is going to have a lot of trading range trading, lots of reversals. And it's possible that it stays sideways for a long time. Sometimes it'll stay sideways for the first half of the day, like bar 40, bar 41, somewhere in there, and that, or even longer, 50 bars, and then trends into the close. The bears want trend resumption down, bear trend, trading range, another leg down, and the bulls will want a trend reversal up, bear trend, trading range, and reversal up. they'll try to get it back at least to the open and have the day become a doji bar on the daily chart. Okay, I'm going to step aside. Brad is going to take over. But right now it's a lot of trading range trading, a lot of scalping. So most traders, there's really not too much to do. You can patiently wait until something is really clear. But right now, it looks, what we're doing is a lot of reversals. Goes up a couple bars, goes down a couple bars. Anything bearish, they buy. Anything bullish, they sell. Bears are trying to get a second leg down, but they really need to do more. It looks like we're probably going to bounce here and get up to the moving average and then decide, are we going to reverse up to the high, or are we going to form a bear flag and finally break below the range? All right. Hope everybody has a good day. Brad's going to take over.
Give me just a moment and I'll start talking, but probably going to pull back here. Bears trying to get the downside breakout below the low one, but bottom of a trading range and the 60-minute moving average. So we could easily reverse up here. I think we're probably going to get closer to the moving average. This does not look bearish enough to be selling at the bottom of a trading range. It'd be better for the bulls if they had a stronger buy signal bar here, though. But probably going to pull back and test the 27 low. You can see some bears disappointed who sold below 30 with 31, and they may look to buy back shorts near the 30 low. But the bulls failing to get an upside breakout. Again, I'd be more bearish here if we were below the moving average and the bars to the left. Nobody wants to sell here and use a wide stop because we're in a trading range. So I think it's better for most traders. The bears, you have bears that are short, but if you get a bull bar closing on its high, I think it's reasonable to get out and look to sell a pullback. The bulls, they have yet to get a strong buy signal bar. But ultimately, if I'm going to sell here, I'd rather sell on a downside breakout. Sell a big bear bar closing on its low somewhere down here. Look at the entire day that we've had. Rally for 2 legs, broke above this high, sold off, deep pullback, second leg down. And it just seems confusing. And whenever it's confusing, you know the market is in a trading range. Trading ranges like to test the moving average frequently. And that makes me think we're probably going to pull back here and get closer to the moving average. Probably test the 27 low. Now, why would we test the 27 low? Because trading ranges close breakout points. Trends keep breakout points open. But if this is going to develop into a strong breakout in a trend, there will be plenty of time to sell later. So I think ultimately, if the bears are going to get a strong trend here and a strong downside breakout, they really need to close below the 12 low. Ideally, consecutive closes below the 12 low. Otherwise, everyone's going to assume that the price action to the right is going to look like the price action to the left. And that price action to the left is trading range price action. It's easy to be hopeful in a trading range. It's easy to be hopeful that you're going to get a successful downside breakout in the start of a bear trend. But right now, the bears have not proven that that's what's going to happen. And until the bears can demonstrate or prove that we're going to get a strong breakout, I'd rather look to sell higher. The bulls are not getting decent stop entries, though. So while we're low in a trading range, the bulls are not getting credible buy signals. Inside bar, not a great sell below, not a great buy above. But I suspect we're probably going to pull back here. One of the reasons why it's a mistake to put a stop below 21. It's one thing to exit on 28 as the market's going down. but putting a stop below 21 is not really ideal. And this is why. The market has gone below 21 down here, but until we clearly break below the 12 low, I think the market is in a trading range, and because of that, we could easily pull back all the way up here. Bears doing a good job preventing the bulls from getting strong bull bars. So let's see what they get here. Can the bears get more follow-through selling, or will the bulls get a reversal up? Possible wedge, 29, 31, and a new low. Even if we get below 12, probably buyers below. So again, until we break clear strongly below 12, we're still in a trading range. The bears, they want to measure move from the measured move of bar 28 or 27 and 28. It's good for the bears that this gap is open, but the bears have not yet done enough. Although the bears have not done enough, you have to ask yourself, why aren't the bulls getting strong bull bars? Inside bar 32, we broke below it. It's you can call it a fractal wedge or a micro wedge. It means the same thing. On a 1 minute chart, you can see the wedge right here, 1, 2, and 3. So the bulls, they want a wedge here, here, and here, and 2 legs up. What did the bears do? Where did the bears get out? I think it's credible for the bears to, if 33 is a bull bar closing on its high, I would certainly get out of shorts. If the market goes, if you get a bull bar closing on its high, this is a bear bar, and the next bar is a bull bar closing on its high, I think it's worth getting out of shorts. But at the moment, probably buyers below and more sideways to up trading. Now the bulls, what do the bulls need to do to get an upside breakout? For one, they've got to stop the selling. When they stop the selling, they've got to get an upside breakout. And then ideally, they need to break above the moving average. Here, bull bar, follow through, but look where it is. It's right near the open of the day. And this, I think the bulls really needed one more bar with 23 to convince traders that we were going higher. And then we had bad follow through on 24. But the bulls needed one more bar after 23. Bad follow through on 24. Disappointed bulls got out on 25 and we sold off. 33 closed below 32, but again, a wedge. And I think the odds are we're probably going to pull back here. So at the moment, I think we're going somewhere up here. 49.62, test the moving average, test the 27 low. I think we're going to do that before we break below 12. When I say break below 12, I mean a strong breakout below 12 and a bear breakout and measured move. Bulls trying to get the upside breakout. Again, I'm not convinced that we're going all that far, but I do think we're going to try and get a little bit closer to 49.62 in this area. You can see a micro channel since bar 24. 10 bar bull micro channel, 10 bar bear micro channel. But selling a 10 bar bear micro channel is great if you're in a relentless bull trend. And even then, it's still fairly climactic. But let me back up. Selling a strong breakout in a micro channel is generally a good idea when the market's clearly bearish. 10 bars of a micro channel is climactic behavior, and it increases the risk of a pullback. Selling a micro channel that's 10 bars at the bottom of a trading range with a lot of overlapping bars is generally not a good idea. So again, I think you'll have more and more bears start to exit here, knowing that we're probably going back up here. That's why, this happens all the time with traders. They end up, and if you listen to Al earlier today, you heard him say, if you're buying up here, the stop is probably below 12. And even then, it's better to probably have a stop about 20 ticks below 12. So 4 or 5 points below the 12 low. And the reason is this right here. You can get a steep sell-off all the way down to near the 12 low, and then a reversal up. Now, reversal up does not mean we're going to go above 24. It just means we're probably going to test the middle of the sell-off and the breakout point, the 27 low. Trading ranges are always forcing traders to trade small. And that's why up here, not a lot of traders were interested in buying, because they didn't want to have a stop all the way down here. And if they did, they were trading really small, looking to buy more lower. You can see testing the high of 29 here, pulling back, but probably buyers below 34. Is it a buy above 34? I don't think it's that great of a swing buy. The risk reward, it's a big bar and probably going to have a tail above the bar. However, I do think we're probably going to go sideways and test up to this area. So buying above 34, not ideal. What about selling below 34? It's in the bottom of a trading range, and selling below a big bull bar with a relatively big is generally a bad idea. So probably buyers below 34 and a deeper pullback. Bears trying to get the breakout. But again, they need a strong breakout below 12. Otherwise, there's probably buyers not far below. The bears are hopeful that they can keep the market below the moving average and stabilize below it, and then get the downside breakout. But again, you can look at 34 and 35 and tell that the bears are not doing enough. If 35 closes on its high, I think you'll have more traders begin to exit here. More bears begin to exit. By the way, I've turned on the question box, and I'll take a look at questions here in just a little while. Questions here in just a little while. For the bulls, micro double bottom, 33, 35. So a better bottom. So once again, if we get a bull bar, I think a lot of traders will begin to exit. I think a lot of bears are already exiting here. This is just not what you want to see if you're looking to sell. Selling low in a trading range with no momentum is generally a losing strategy. So the reason we're reversing up is you have a lot of bears concluding that we're not going to break to the downside. And if we're not going to break to the downside, the market has to probe higher to find enough traders willing to sell. And that's what's going on here. You can see 34, it probed up to the high of 29, the start of the channel, and we found more sellers. Some sellers at the high of 34, but again, this gap, the 27 low, is an obvious gap. And there's some sellers at the moving average. But I think the market's probably going to go a little bit higher and get back to the 27 low. So a lot of traders are hesitant to sell here. Now you will have some bears selling, trying to keep this gap open. If they can keep this gap open and get a a reversal bar and a strong bear breakout, there would be an increased risk that we start a trend. But again, we would have to break out of this range down here, the 12 low, and we'd have to do it in a big way. The majority of traders see the sell-off down to 33 as just a pullback from the rally up to 23. See, this is what I was talking about. It's generally a bad idea to buy the low, to be long up here, and exit right at the low of 21. The reason for that is you get stopped out here, the market starts to go sideways, and look where it is. The market's back above your entry. Trading ranges are always forcing traders to sell too low in the range. Or let me back up. Trading ranges are always forcing traders to to sell out of longs low and get stopped out. So again, this is due to traders not wanting to sell all the way down here. For whatever reason, my trading computer has gotten very slow all of a sudden, so I'm going to restart it. Which unfortunately, I might miss getting to buy right here. But it's about 10 or 15 seconds behind this computer. And usually, the fix for that is just deleting the cache and then restarting it, and it seems to work just fine. But obviously, traders buying here. So big bull bar, we're probably always in long. However, and we're closing above the moving average, both good things for the bulls. Nothing wrong with waiting for follow through. If 36 is going to lead to a strong breakout, then 37 should have strong follow through. So if we're going to go all the way up here to the open of the week, we should get strong follow through. So it's similar to what Al mentioned over here. We had a bull bar and then a doji. It'd be better for the bulls if we could get, if this bar here, bar 14, could have been a strong bull bar closing above the moving average, similar to this. Lots of closes above the moving average, probably going to go higher. Would I sell here? No. It's too strong of a bull bar. So big bull bar 36, but where's the follow through buying? So obviously disappointment. Just like the bulls were able to get back to the 27 low and close the gap, what are we doing over here? We're testing breakout points. I have my other trading computer up now, and looks like the data is syncing up just fine. This is exactly why a lot of traders don't want to buy a big bull bar in the middle of the range. Too much risk of a reversal. Bad entry bar 37, but not a good sell below, so increases the probability that the bulls will get a second leg up. Now, if you're long here, do you get out below 37 or 36? I don't think so. Again, traders buying here, if the market falls below 37 or 36, the reality is it's a trading range. There's probably buyers down here. So not really an ideal place to be selling out of longs below 36. Euro versus the dollar. consecutive bear bars on Thursday, on Friday, and yesterday, but bottom of a trading range. So we may go more sideways here until the bears break strongly below the December low. We're probably going to remain in a trading range, and I suspect we'll probably pull back, although the selling here and here is strong enough for a second leg down. So for the bulls, 36 probably strong enough for a second leg up. Therefore, we'll probably, at a minimum, we'll probably test the 36 close. Bulls, they buy the close at 36, scale in lower, get out, break even at the 36 close. Other bulls hold long, betting on a second leg up. Situations like this, I'll often buy a pullback of 37 when it looks like a bad stop entry sell below, and then decide what to do on the retest, scalp out or hold for a small second leg up. 38, bull inside bar, closing on its high. Probably going to go at least a little bit higher. Two bull bars above the moving average, but no body completely above the moving average. 36 above the moving average, good for the bulls, but only the upper third of the bar is above the moving average. It'd be better if we can see a bull bar completely above the moving average. So 39, it'd be good for the bulls if 39 is a big bull bar closing somewhere up here. High one buy, it's a retest of the rally to 36. So in other words, it's a double top. You can see it right here. The market rallied on 36, had a deep pullback 2 bars ago on 37, and now it's retesting the high close on 39. And the market's deciding, are there more sellers up here or buyers? Because the bears tried to get a sell-off down on 33, and they had several attempts, and 36 is a little bit of a surprise, I suspect we're going to go at least, I suspect we'll probably get a small second leg and at least get up to 49.66. It's possible that we have to get up to the 23 close and maybe the open of the day, but not yet clear. You can see we touched the high close of 36. Not a lot of urgency to break above it. We probably will. If 39 closes on its low, will bears sell below it? Some might. We've been below the moving average for maybe 6-7 bars, but this is not that strong of a sell-off here. And that makes me think that there's less urgency for bears to sell. Here, strong bull trend, there's going to be buyers at the moving average. Let me find the opposite. Strong sell-off, there's going to be sellers near the moving average. Strong sell-off, but overall trading range, not as much of a need for there to be sellers at the moving average. And today, the problem that the bears have is we broke far above the moving average on 36. Bulls want to get up to the open of the day. Consecutive bull bars may go at least a little bit higher. So now we have consecutive bars above the moving average. Good for the bulls, but middle of an overall trading range, and that is bad for the bulls. If you're buying, do you put a stop below 38? Probably not. I think ultimately it's better if you can use a wide stop and scale in lower. You can see not a lot of traders want to buy up here. Bears, they're hopeful it's 2 legs up and the upper portion of a trading range, and now we pull back all the way to the 37 low or 37 high. And we might. This is what I meant by I wouldn't put a stop below 38. if you're buying up here, it's better if you scale in lower. And it's still buying at the top in the upper portion of the trading range, so not ideal. This is what I meant. I wouldn't put a stop below 38. If anything, the bulls buying here are buying more lower using a wide stop. Actually, give me a moment. I'm trying to exit a trade. And then I'll just carry on with what I was saying about line charts. So we're going sideways here. I still think we're going to get a second leg up. Okay, good enough. So why are line charts important? Line charts are beneficial, and a lot of traders use them because it explains the basic support and resistance of the market. This is what's most important, context. So we look at a 60-minute chart. We've been in a bull trend for days and days. Here, we broke to the upside, had a deep pullback, and now we're in breakout mode. That's what's important. And now let's go to a 5-minute chart. Someone asked about, and the reason I'm bringing it up is someone asked about bar 16. Is bar 16 a reasonable sell? And they sold, I'm assuming they sold here, got stopped out a few bars later. So bar 16 is 9:50 Central Time. This is a 5-minute chart. Here's today's price action. There's bar 16. So look at that bar. It's hard to see it. But do you really want to sell right here? Of course not. If you've looked at the video, if you watch the video course, the most recent one of Al's, you'll notice he talks a lot about, he references how you can often look at a bar chart and decide on where to enter. So here, do you buy after 2 or 3 of these bull bars? It's actually reasonable. And part of the reason why it's a logical area to buy is consecutive sell climaxes all the way down. Odds are we're going to test the moving average. Lots of bull bars above the moving average, first reversal down, probably going to fail. Consecutive sell climaxes all the way down. Odds are we're going to test the moving average. Lots of bull bars above the moving average, first reversal down, probably going to fail. So bar charts can help you with better checking yourself as far as context goes, making sure you understand the logic behind the context. Well, there you go. So I just took half off. I bought on the way down and took half off. And I'm taking a chance that we get back to the open of the day. Good bar for the bulls. You can take the buy for a swing, maybe stop below 43. And if you do, you just get out below a bear bar. Very often, if I ever start a target at the open of the day, what I'll often do is I will set it 2 ticks below the open. So the open is 70 even. If I'm going to set a target at the open of the day, I'll put it at 69.5. And that's where I have an arbitrary target right now. That is a swing trade. If we stall for too long, I'll just take the profit I have and move on. If we get a strong breakout bar, maybe I'll consider adding on. I just went flat on my remaining position. It may go higher, but we're in the middle of the trading range, and I really would prefer the breakout to get stronger. I got to step away for a few. But if we get follow through buying, especially if it closes on a tie, I think it's reasonable for a test to the open of the day. But the bulls need strong follow-through. Otherwise, bears will see this as another expanding triangle, which we've had expanding triangles all day. Al's touched on that if you've been listening. Okay, I'll be back in about 10 minutes. Looks like I didn't miss much. So you can see right here, that was my concern. 3 pushes up, expanding triangle, bad follow through after a big bull bar, and then a sell off. But look what happened. Bulls who bought up here, scaled in lower, they had a chance to get out break even at their first entry, profit on their second. And the reality is, we're still probably going to get up here. Now this range is contracting, and contracting ranges are always triangles they're always triangles. And that's a breakout mode pattern, which increases the probability of a breakout up or down. It's easy to be impatient when you see these kind of days, but it's really important to be cautious. Tight trading range, probability is low for the breakout up or down. Best to assume it's close to 50-50. My last trade was buying during 38 and getting out. I took half off here, and then somewhere in this bar, I exited the rest around somewhere in here. I was taking a chance we'd get to the open, but when 43 closed, I wanted 44 to go up rather quickly, and it took a minute or two and stalled, and that made me impatient. If I'm buying high in a trading range, I don't want to feel like the only person buying high. I want to get swept into a trade. If you're selling a bar like 28, you want to get swept into a big move. If you're selling a bar like 6, you want the market to go further down. You don't want to feel confused. So whenever you feel kind of anxiety, it's, you look at this and you feel anxious. You don't know if the market's going to go up. You don't know if the market's going to go down. Every bar changes the market's direction. That's a trading range. And in a trading range, it's best to be patient. Wait for the market to clearly break out up or down. That's what causes traders the most headache and the most issues. It's really common for traders to enter too early. They see a bull bar on 48 and they really want to make a profit, so they buy 48, taking a chance that we break out to the upside, and then we continue to do this. Sure, if you buy above 48, your risk is small. Your risk is only, about 3 points, maybe 3.5. Your risk is small, but you're risking 3 points, taking a chance that you make 7 or more points on the day. Whenever you have small risk, you have low probability. And if you take a lot of stop entries in a tight trading range, you buy above 38, get stopped out below 38, you buy above here, get stopped out, then you buy again here. Even if 48 is profitable and takes you up here, it'll probably just be enough to make up for the past losses. So again, that's why traders, when they're long, they use wide stops. It's kind of like all the way up here. If you're buying the close of 23, you got to ask yourself, do you really want to exit down here? So another big bull bar at the same close as 43, probably going to go higher here. So this might be a leg 1 complex pullback, leg 2. I did not buy above 48, and at this moment, I'll probably wait to see the follow through. People are asking about coaching sessions. There will be coaching sessions in the future, fairly soon, maybe in a week or two. There's not going to be any this week. I will obviously post the end of day review in the trading room, so stick around once the market closes and I'll answer questions. But as far as coaching sessions, those will be down the road, and those coaching sessions are probably going to continue to cover pieces of the video course. What I'd recommend everybody do at the end of the day or later tonight is mark up charts and really spend time thinking. And that's one of the secrets to trading. It's a lot of information to really learn and understand. But the key ingredient is you have to spend a lot of time thinking about the market, looking at slides, looking at the encyclopedia, watching the video course, thinking through the video course. And the other thing, a little tidbit of information, I think you have to learn that charts, there's no special chart. A 5-minute chart, 7-minute chart, none of them are special. If we go to an 7-minute chart right here, it's no different than the 5-minute chart. So whenever I'm looking at the market, sometimes I have a workspace, and what I like to do, I'll pull one up in a second, but what I like to do is pull up 2 different charts. So I like to look at a 5-minute chart and a 2-minute chart. And there's 2 charts on each side, an 8-minute chart and a 4-minute chart. I'm not doing that when I'm trading. That's kind of practice once the market's closed. And the reason I do that is to help me better learn and remind myself overlap. So these bars right here, if we go to a 12-minute chart, that tight trading range we've had is just a series of overlapping bars. And overlapping bars are dangerous to sell below and buy above. Let me load this chart and I'll explain further what I'm talking about. I want to see how this bar closes. Remember what Al said about expanding triangles? They're everywhere. There's not really an expanding triangle here. A little bit of one on the open. We had an expanding triangle here. We had an expanding triangle here. So when you get expanding triangles, it's common for the market to create a series of them. Another thing to consider is when you're trading, it's important to be patient. I found that the more patient I am, generally, the better I do. The more I'm in a rush or in a hurry to try and take a trade, I find myself making more mistakes. Consecutive bull bars, 48, 49, 20 seconds left in the close. So again, if I'm going to buy high, I really want to see momentum. I want to have a reason to buy high. I want to feel like I've got to chase the market up, or else why would I want to buy? So look at this bar right here. Do you really want to buy 49? If 49 was such an impressive bar, and it's good, consecutive bull bars above the moving average, it's a good bar for the bulls. But if it was such a great bar to buy the close, why didn't we rally into the close of the bar? Do you notice how in the last 20 seconds or so, we pulled back? Part of the reason we're pulling back is traders believe it's in a trading range. It's not really breaking out of the bars to the left. It's consecutive bull bars, and that's good for the bulls. However, it'd be better if 49 was an even bigger bull bar. It's still always in long. You can buy for any reason. I say that. You can buy, but you probably need a wide stop and the ability to scale in. If you're buying right here, your risk-reward, the risk-reward is the issue. If you bought to close the prior bar, stop below 48, 1 times your risk is up here. And again, do you really exit below 48? That's the problem. I think if you're holding all the way to the 48 low, I think you're better off putting a stop down here around 33, which means your stop is much bigger than what you anticipate. And therefore, a lot of traders buying here with a wide stop down here, they're going to exit if we get 2 or 3 big bear bars. Bulls trying to get the upside breakout. So let's see what kind of follow through we get. We're getting near the high close of 43. That's another logical magnet. Obviously, getting the breakout to the open of the day. So looking good for the bulls. A little bit of a climactic bar on 50. But a strong enough rally, probably the first reversal down will fail. 3 consecutive bull bars, but really close to resistance. So a tough area to be buying. Because of the 3 consecutive bull bars, I suspect the first reversal down probably will fail. The risk for the bears, for the bulls, is 2 legs up in a double top with 50 with 24. So 51 is a big bear bar. It's probably okay to exit longs. Otherwise, you probably need a really wide stop. You can see traders buying a pullback during 51. 51 was also a retest of the 44 high. Bears sell the 44 high, scaling higher, trying to get out break even. We'll probably get back down to the 44 high, but we may have to get up to the open of the day first. And what are the chances that we get up to the high of yesterday? Now, why is yesterday's high important? It's important because yesterday's high is a high one buy on the daily chart. So you can see it right here. We have this high one buy right here, this inside bar. And for the bears, it's a reasonable, let me adjust something here. For the bears, trying to adjust part of what I'm doing here. Give me 2 seconds. I'm long, and I'll take half off. I'm taking half off about 2 ticks below the open of the day, and I'll wait and see how the rest develops. Anyways, back to what I was saying. We have an inside bar. Inside bars are always high ones, so it's a breakout pullback buy setup on the daily chart. And because of that, because we have a breakout pullback buy setup on the daily chart, you will have traders. What's really common with high ones is for the high one to trigger, pull back, and then go above the high one. So you have to think about the logic here. We triggered. It's not all that clear right here, but okay, I just got filled. We triggered the buy above yesterday, and we went about 3 ticks above the high here. So this blue line is yesterday's high one. I'll note it like this. So here's yesterday's high one. And if we rally all the way back up to it, that would form a bull bar above yesterday's high one. It'd be a better stop and true buy. I don't know if that'll happen. Obviously, we're far from it. And the bulls, they really need to do more if they're going to accomplish that. So it's not yet all that clear. But that is certainly one thing traders are weighing as far as what's likely. And you can see we touched the open of the day and we pulled back. It's really weird. I'm going to delete the cache data on this computer for the trading room. It's interesting to see that here on this chart, the open is 70 1/4. On my trading computer, the open is showing that it's 70 even. So I'm showing a discrepancy in the data. Whenever I see a discrepancy in the data, I always go to the CME website and verify what I'm looking at. So here is the open, and the open is showing 70 even. So this is actually wrong. The open is 70 even, not 70 1/4. So really, the open of the day is right there. So we actually went one tick above the open of the day and turned down. Someone said that my data is slightly behind, and I verified that my data is moving accurately because this computer is streaming to go to webinar. There could be a slight 2 or 3 second delay in the what I say versus it being transmitted. So that's one thing to be aware of. What I say versus it being transmitted. So that's one thing to be aware of. So now we have 5 consecutive bull bars and an inside bar on 51. Inside bars for high ones. But because the channel up is tight, I suspect we'll probably get a second leg up. Always in long, so no reason this channel up's too tight. The only thing I would do is buy or buy pullbacks. Testing back to the inside bar on 50. It's fairly common whenever you get an inside bar for the market to retest the range of the inside bar. Probably buyers below 53. You can argue second leg trap, leg 1, pullback, leg 2, nested for the second leg, leg 1, pullback, leg 2. But with this many bars up, and you have all of the bars closing above their midpoints, I suspect we're going to go at least a little bit higher. I don't know if we're going to go all the way up here, but I think we'll probably get a small second leg up. Bear bar closing on its low. Possible second leg trap, but I'd rather see consecutive strong bear bars before I'm interested in selling. This is too strong of a rally to make me think that 53 is going to lead to a successful reversal. And if you're long, you can get out below 53, but I'd rather wait and see consecutive bear bars before I'm all that interested in selling out of longs. It's certainly disappointing, and you'll have some traders selling out of longs back at the open or the close of bar 52. You can see bears unable to trigger the sell below 53. That's a sign of strong buying pressure. I took half of my position off. I don't remember where I bought. I think I was long part. I added on a pullback, but because of 53 closing on its low, even though it didn't trigger, and I think we're going to go a little bit higher, I wanted a stronger breakout. It's good for the bulls that 53 failed to trigger the sell. Increases the probability that we'll go at least a little bit higher. Part of the reason why I reduced my position is it was a little bit bigger than I'd like it to be. And I'd rather give myself the ability to add on depending on what the market does. So a bull bar, probably going to go at least a little bit higher. So no sign of a top yet. Therefore, I would not sell. 15-minute chart, 3 consecutive bull bars, probably buyers on the first reversal down. Second entry sell. It's possible that we get all the way back down to the 44 high. That's a breakout point. But I suspect buyers on the first reversal down. Surprisingly big breakout. May get a small second leg down. But I think we're probably going to go more sideways here than straight down. But certainly disappointing for the bulls. Is it always in short with 55? I don't think so. I think the bears, And if the bears can get another big bear bar on 56, it'll be always in short. But like I said, probably buyers on the first reversal. You can see what 55 did. It went one tick below the 60, the bar 44 high. So the bears who sold the high of 44 and more higher around the open of the day, guess what? They made money. And that was to be expected. So bulls are disappointed, and that will limit the upside. What are the chances that we get up to yesterday's high one? I don't think we will. I think we're going to be in a trading range, and the market is telling us here that we're getting closer to the top of the range. The top of the range could be above bar 55. But we're probably going to begin to go sideways fairly soon. The other problem that the bulls have, we're not above the bars to the left. Strong enough sell-off, this could be a complex two-legged pullback, and we get a second leg down. So let's see what the bears can get here. It'd be better for the bears if they can get consecutive strong bear bars. That would increase the probability of a reversal down to the 48 low. Clearly, bulls giving up, so probably going lower. I think a lot of traders would rather see how this bar closes. Like I said, some bulls might have a stop all the way down at 33 low. Strong enough breakout, second leg down likely, but the pullback could be pretty deep. 56 is enough to make the market a trading range, and we're in a trading range. It's a strong enough reversal. We'll probably get a second leg down. The question here is how deep of a pullback will we get? We have a tail on 55. We may get another tail on 56 and get a 50% pullback of these two bars. Certainly okay for bulls to exit though. Obviously, bulls giving up increases the probability that we go lower. We may get all the way down to the 12 close. The bull should not have allowed this to happen, and because of that, we're probably going to go get at least a second leg down. Bar's getting big. What are the chances we get down to the 12 low? We might. This is a big enough bar to make me think we're going to go at least a little bit lower. Tail on 57, but a big enough surprise that we're probably going to get at least a second leg down. Therefore, I think it's a bad idea to buy below 56. Always in short with 56. And when you look at 56, it's a surprise. And surprises often get second legs. That makes me think we'll probably get a second leg down, even if we get a deep pullback first. Now, what about the bulls who have a stop below 12? The problem with that stop is you probably need a stop 4 or 5 points below 12. So if the low of 12, we do it like this. The low of 12 is 55 even. You probably need to stop somewhere down here if you're buying in this area. And 56 is a strong enough bar to make me think we're going to go at least a little bit lower. And because of that, I'm not interested in buying the low of buying in this area. Now, why would I put a stop? If I was going to stay long, why would I put a stop 4 points below 12, because this is a trading range. And what you don't want to have happen is you don't want to be long right here, stop below 12, one tick below, the market race down to the 12 low, start to go sideways and reverse up. Now for the bulls, it's okay to be long up here. It's high in the trading range, so it's not ideal. But the reality is, if you're a bull and you're long, you're buying betting on a trading range. And the problem is, you can only buy high if you're willing to get out quickly below this bar or as this bar starts to go down. If you're going to stay long, once the momentum down is becoming strong, the problem is you really need to stop down here. So I think that's why a lot of traders would exit. This is too much selling pressure for a lot of bulls to be interested in buying. So to me, 56 changed the premise for the bulls. Possible measure move down at 56. Now 56 is a lot like bar 6. It's a big bar in a trading range, maybe 6 and 7. So 56 has good momentum to the downside. But the problem with 56 is you're in the bottom of a trading range. Therefore, a lot of traders, the only traders that are selling here, they're selling because the momentum is strong for the bears. If the momentum dries up, starts to do this, you have a lot of traders buying back shorts. The problem I have here is all these bulls here who are long are holding a losing position. And that makes me think the first reversal down will fail. Look at it on a 15-minute chart. All these bulls who bought here are holding a losing position. It's possible we're getting a second leg down from the sell-off that happened at 9:15 over here. So I suspect the first reversal up will probably fail. Again, the reason I'd be out of longs indefinitely is I think the odds are high we're going to fall below 12. I'm going to turn the screen off for a moment. Consecutive bear bars, still sell to close, probably going at least a little bit lower, but bottom of a trading range, so the pullback can be deeper than what traders want. Whenever you get a surprise, usually you get a second leg. Bear surprise, small second leg down, but it even led to sideways trading for several bars. Big surprise. I think this is more, I say that, what we have today is more in between this and this. Breaking far below the moving average, probably going to get a second leg down. Now, it's not the same as, let me find it here. This is not the right slides, but it'll work. It's not the same as this. Here, big, it's the opposite, the big bull surprise closing above everything to the left. And you can see the next several days formed a trading range. So this is much different. A strong enough selling, first reversal up probably will fail, and we'll get at least a small second leg down. So I think the odds are really high we're going to fall one tick below 12. And the reason I think that is if you're a bear, let's say you're a bull and you buy at the market right here and put a stop below 12, you know there's much greater than a 60% chance you're going to get stopped out. And the bears who sell and have a stop up here, betting that we're going to get to the low of 12, they have terrible risk reward. Whenever you have bad risk reward, you know the probability is high. So still sell the close, low in a trading range, but so far we have a breakout with follow through, and that increases the probability that we're going to go lower. I think it's really important whenever you're long and you start to see a big bar and you can sense that the market is doing something you didn't expect, a big bear surprise. Doesn't matter if you're up here and you think it's going lower or it's all the way down here. The best thing you can do is exit and wait for more information. Sure, you can stay long and hope that this is the bottom of a trading range, wait for the market to go sideways for 10 or more bars. However, you'll expose yourself to the risk of a second leg, and it's possible that we break below 12 and go all the way down here to 49.50. It's possible we get a measured move of this bar. It's possible we get a measured move down to here, and we just don't know what's going to happen yet. Even this sell-off right here, overlapping bars, first reversal up failed, and we got a second leg down. I'm not expecting a strong bear breakout all the way down here, but I am expecting at least a small second leg down. Do bears exit above 58, betting on a higher low or a double bottom in a trading range? Some might, but I think the first reversal up, I think there's sellers above 58, and we'll probably get at least a small second leg down. And would I buy above 58? I would not. I'd rather wait and see what kind of follow through we get on 58. And even then, I'd rather see probably 2 or 3 strong bull bars. 58 is not a strong stop entry buy, and that increases the probability that there's sellers above 58. And that will at least go sideways and get a second leg down. Some bears who sold 57 disappointed with 58, and therefore they'll look to exit on any retest of the 57 close. You can see we're retesting the 48 low. This is a reminder that we're in a trading range. We get really close to the 12 low here, and we reverse back up to the 48 low. Bears should not have allowed this steep of a pullback. That will increase the probability that we go more sideways. And this is a reminder that the market is in a trading range. Possible 50% pullback of the sell-off. So as strong as these two bull bars are, 58, 59, I still think 56 and 57 is enough of a surprise that we'll get a second leg down. But if you're a bear and you sold the close, how are you feeling about 58 and 59? Obviously, it's disappointing. And if you're disappointed, then you're probably going to look to exit on any retest. So this is not what you want to see if you're a bear. But again, bulls who bought up here and scaled in lower, I suspect they're going to use the first reversal up to get out break even, as close to break even as possible. And that makes me unwilling to buy the first reversal up. This 58, 59 is probably similar to this bar right here, bar 10. You can see how this bar is moving around a lot, intra-bar. Rally, pullback, inside bar, consecutive bull bars, bear bar. This looks more like a leg in a trading range. It's good for the bulls. It's 5 consecutive bull bars. But if we start to go sideways here, we'll probably reverse back down and test the close of this bar. So as strong as this rally is, it's getting a lot of overlap, and that increases the odds of a deeper pullback. What about buying the close of 59? I think it's okay to get out of shorts and then look to sell again on a pull, look to sell again below a bear bar. But 58, 59, it might be strong enough that the first reversal down will fail. But because of the tail on 58 and 59, I suspect that we're probably going to get a lower high and a second leg down. But the pullback could be deeper than what traders want. Pretty typical. You get a vacuum test of the lows and then a deep pullback, making traders question, are the bears Are the bears now trapped and we're going to rally all the way up here? Or are the bears trapped into a losing position and they're going to give up, causing a rally back up here? Or are the bulls who bought up here and scaled in lower disappointed, and therefore they're going to use whatever bounce they can to exit? At the moment, I don't think the prior two bull bars is enough to undo 56. Obviously, if 60 is another bull bar closing on a tie, that'll entice more bears to exit. It's really common whenever you get a second leg trap, leg one, pause, leg two, or leg one, pause, leg two. You test the bottom of the second leg, either the 45 low or the 33 low, and you begin to go sideways. The midpoint of bar 56 is 62.5. Looks like we went up to 62.25. So we're near the midpoint of this big bear bar. The bears need to stop the bears need to stop the buying pressure. They need to put a halt to the buying pressure and then start to get bear bars closing on their lows. 61 is a low one short. Do you buy below it, betting that low ones typically lead to deeper pullbacks? There might be more buyers below 60, but because of the surprise on 56 and 57, I think it's really hard to justify buying the first reversal up. Too much risk that we sell off, that we still have to test near the 58 low. Let me go back to that 1 minute chart, and you can see it pretty clearly here. First reversal up, probably going to fail, and we'll probably get back down here. So you can see parabolic wedge on the 1 minute, lots of bars up, good for the bulls, but then we start going sideways, and a lot of those bulls get out on the 1 minute chart. Obviously, most traders should not trade a 1 minute chart, but this rally, which is the equivalent of the 58 low to the 59 high, starts to go sideways, and now it's getting deep pullbacks. And then we start to form a trading range, and that will increase the risk of a second leg down. Trading ranges are always forcing traders to have to scale in. And if you think about why, it makes sense why. The market is trying to create transactions, and the more transactions, and the more traders trade and the more transactions that occur, the tighter the bid-ask spread. And the tighter the bid-ask spread, then the easier it is to buy goods and services at a fairly neutral price. And because of that, the market very often will force you, if you sell low in the range, it'll force you to sell, scale in higher, have to get out break even. So enter here, scale in up here, maybe get out break even, maybe get out at your first entry. So tail below 60, not a good sell for the bears, probably buyers below. But after 3 big bear bars, I suspect we're going to test down to the 57 close. Certainly disappointing for bulls. For the bears, I think sideways here is more likely than going all the way back up here. More likely, we're going to go sideways and probably test the 57 close. The bears, they're hopeful this is the bear flag, and we'll test down to the 57 close, 58 low, and break below it. Bulls, they want a trading range, and buyers down here. So everyone's going to pay attention to see how strong is the test down. If it's a big bear bar, then we may go a little bit lower. I still think at least, probably 50-50 chance we're going to get down to the low of 12. But I think bears are also disappointed down here. And this pullback is a reminder we're in a trading range. So you will have some traders buying back at least part of their position down here. And if I was a bear and I sold and scaled in, I think it's okay to take half off at the close of 57 or low of 58. And then as far as being long, I would not be long. This is too much selling. And I think the odds are high we're going to get a second leg. So what that means is I think there's a very high probability we're going to go one tick below 58, the low of this bar. And we could go much lower than that. Tail, so disappointing for the bears, but we'll probably still test down here and at least go one tick below 58. You can see some disappointed bears sold here, scaled in, buying back shorts. But probably going to go at least a little bit lower. Disappointing for the bulls, disappointing for the bears, 63. But forcing you to buy after a big bear bar, 62. There might be more sellers above. You'll have some bulls exit and you'll have some bears exit above 63, waiting to see what kind of follow through we get on 64. But 63 is probably a minor reversal up. But this is a reminder we're in a trading range. Bull bar. And here we go. So bull bar, second entry buy, 63. I think it's okay for bears to exit above 63 and wait and see what we get. However, this could just be a two-legged pullback, leg one, pullback, leg two, and then we get a second entry and a second leg down. But obviously not ideal for the bulls. Not ideal for the bears. Possible double top with 62. And what do the bulls do if 64 reverses down, forming a bear bar closing on its low? I think those bulls will probably exit. We're in a tight trading range here, and the bulls are trying to break above it. But let's see what kind of entry bar the bulls get. So far, the bulls are doing a good job, but they need to do a little bit more. And it'd be good for the bulls if they can get a strong bull bar 64 closing above 62. That would increase the probability that we test back up here. But you can see there's a lot of hesitation right here. So I have about 2 minutes left until this bar closes. Not good for the bears. The bears shouldn't have allowed this double bottom, increase the chances that we rally back up here. But I like to see this bar close on its high. Otherwise, if it sells off around the midpoint of the bar, then we could still be within. This could just be a two-legged pullback. Consecutive bull bars, probably going to go at least a little bit higher. The always in bears probably got out above 63. And I think the bears need a strong reversal bar here in order to convince traders to sell. And that makes me think we're probably going to go a little bit higher. And we may get all the way back up to this area, the open of the day, and relieve the trapped bulls. A little bit of a problem for the bulls. If we get a bear bar closing on its low, then unfortunately the bulls have to exit, and bears will probably go short. You have some bears who sold up here, scaled in, and this could just be a retest. You have some bears who sold up here, scaled in, and this could just be a retest. So 65 is an important bar. The bigger the bear bar is, the greater the risk that we test back down here. 65 is an important bar. The bigger the bear bar is, the greater the risk that we test back down here. I think with the consecutive bull bars, 53, 54, that will limit the downside. So probably not a lot of eager sellers right here. So next target, the 55 low, the breakout point. The bear's trying to get a low too, and looks like we're going to get a bad signal bar here for the bears, increasing the risk that we go higher. 3 consecutive bull bars, probably going to go at least a little bit higher. So not ideal for the bulls. Excuse me, not ideal for the bears. Bull bar closing above the moving average. We have 2 bars closing above the moving average, 54, 55. It'd be better if we can get a 3rd strong bull bar. I suspect we're going to test back to the 55 low, and we might test all the way back here. This is not good for the bears. This is a good reminder. Big sell-off near the bottom of the range. Strong enough breakout for a second leg down. This might be the second leg. It's possible 66 reverses down sharply, but at the moment it doesn't look like it's going to. So you have trapped bears. You have bears who sold here, positioning themselves for a second leg down, and this is the second leg down they're getting. They're not getting it, and they're getting a strong reversal. That will increase the risk that we test back up here. This is pretty common when you get a second leg trap. Here's some various examples of second leg traps. This is sort of similar to today, not quite, but you get a sell-off, pullback, big bear bar, breaking below the lows, and then 2, 3 legs up in an upside breakout. The point with second leg traps, it's a surprise. A trap is the opposite of a surprise. So a big sell-off and then a test back up at the highs. I actually kind of said this backwards. What I really meant to show is second leg bull traps. Here, leg 1, pull back leg 2, and then a surprise bear breakout, testing the lows. We rallied, tested back up to the highs of the second leg. Here, leg 1, pull back leg 2. We sold off testing the lows and then reached back to the highs. Same thing right here. Leg 1, pause, leg 2. So here's the second leg bull trap, strong bear breakout. But instead of going a lot lower, we went sideways. And now we're testing near this area. We broke far above the 55 low. Good for the bulls, increases the probability. We go a little bit higher. So any reason to sell? You can probably sell here, scale in, and make money because of the size of the sell-off. But I have to say, with this many bars up, 63 to 66, I think it's better to wait for more selling pressure. Buy climax 66, so increase the probability of more sideways trading. This is always the risk of selling low in a trading range, big bear bar, and then a sudden reversal. And you can see, you had so many traders. You had traders who sold the close of 57 at 57 even. That's interesting. So this is bar 57 and the close is 57. And then look at the low of this bar, 63. The low of this bar is 57 and a quarter. So you have you had trapped sell the close bears who sold, scaled in. They were so disappointed and so desperate to get out break even that a lot of them got out above break even, above the low close, and that's what led to this. Tail on 66, but still probably going to go a little bit higher. Are we always in long? I suspect we are, but the stop's fairly far, probably down here. And so far today, every time the stop has gotten big, in other words, the risk is big, we get a pullback. Probably the first reversal down will fail. So as far as selling here, I think it's better to wait and see more selling pressure. The tail on 66 is probably due more to bulls selling out of longs and taking partial profits than bears selling aggressively. But the longer we go sideways here, the more bulls will begin to sell out of longs, increasing the risk of a deeper pullback. We're 4 minutes into the bar, and we have yet to go above 68. And that's a warning that the bulls are losing momentum. Increases the probability that we pull back a couple of bars. Inside the bar, increases the probability that whatever breakout we get above 67 will pull back within a bar or two. We're so close to the open of the day and the 54 close, the area where the bulls got trapped, that we're probably going to get up there. So we may get a buy vacuum test of this price level. We may get a buy vacuum test of this price level. And what are the chances that we get all the way up to yesterday's high, the high one on the daily chart? It's still pretty far away. We might get there, but right now, I think the bulls need to do more. Chances are we're going to pull back. Getting vacuumed up to the high of 55. Good for the bulls. Buy climax pause, buy climax pause, another buy climax increases the risk that we start to go sideways up here. This is not what a strong rally looks like. It is strong, lots of bull bars, but the overlap, strong rallies tend to look, well, let me close this. I'm saying that I think we'll pull back. I am not saying that I think that this is a good area to start selling. That I think we'll pull back. I am not saying that I think that this is a good area to start selling. You see what happened? Rallied. We pulled back all the way to the open. That's a warning that this is not as bullish as it could be. Oh, my screen's off. I apologize. So what I'm saying, where I'm really getting at is this is climactic behavior, increase the risk that we're going to pull back for a few bars. It's a little bit dangerous to sell because it's a micro channel. But overall, I think we're probably going to go more sideways here than all the way up to yesterday's high. This is what strong breakouts look like. And this is not what we have today. This is what strong bear breakouts look like, this right here. Again, not what we have today. What we have today looks more like a leg in a trading range. I just went flat. I just went flat. I think the odds are we're going to go more sideways than straight up. Normally, when you get a big sell-off and you retest it, you normally go sideways, which means we may pull back all the way down here, 49.64. Sometimes, and it's late in the day, it's already bar 69, so there's not that many bars left. Sometimes you get this. I got to remember the day, January 6th of 23. Yeah. So here's an example where we gapped up with these two big bear bars, and we had these two big bear bars, and then look what happened for the rest of the day. The market just, there we go. The market broke far above this range and then rallied for more than a measured move up. Now, why is that different? Why is that different? It's different because there's more time today. Here, we're running out of time. So this is not, obviously we're not going to get this. More likely we're going to go sideways. Inside bar on 69, but again, I think we're probably going to pull back fairly soon. We could easily get all the way back down to the 61 high, so not really an ideal area to be buying. But there we go, getting a sell vacuum, and we may end up testing the 64 high all the way down here. What about selling the close of 70? I don't know, it might be better to wait. I suspect we're going to go more sideways than straight down. We have an inside bar here, and it's possible 70 is just a pullback from the high one on 69, which is the inside bar. So my concern is we may have to test up to the high of 69. Even though this rally has a lot of overlap, the reason I was concerned about the overlap is I thought we would get a deeper pullback. So that's why I wasn't thrilled about buying right here. I'd rather buy a stronger breakout. This is that deeper pullback. But now we have a deeper pullback. We're probably forming a trading range, which means there might be more sellers above bar 69 than buyers. I'm going to turn the screen off for a second. 70, the bar that just closed. Big bear bar, probably sellers above 70. So not a great stop entry buy above the bar. I'll talk about what I'm doing over here in just a minute. Bull bar, testing near the 70 high, but I think probably going to go more sideways here. You can see disappointed bulls selling out of longs near the highs. But a bad stop entry sell below 70. So probably going to go more sideways here. Bears trying to get consecutive bear bars. They want to test back down to the 61 or 62 high. What are the chances they get all the way down to the 57 low? I don't know. I think there's probably more buyers below than sellers. Consecutive bear bars, inside bar 71, but probably going to go more sideways here. Some traders will get out and look to buy lower, but we're probably developing a trading range here. And there's probably bulls buying below, scaling in lower. So I suspect we'll probably go more sideways than straight down. Trying to get a reversal up, but consecutive bear bars, 4-bar micro channel. I suspect we'll go more sideways here than straight up. So what about selling above 72? If it's a bull bar closing near its high, I would wait. Although it would be 5 consecutive bull bars, the pullback could be deep. So if you are selling above 72, I think you probably sell more up here. So if you're selling anywhere above 72, I don't know if the stop is above 68. You can argue it is. Right now we have a double top with 55, 68. And the bears, they want to sell off and a test down here. It's possible they get that. But at the moment, I think more likely we're going to go more sideways here. And probably test back up to the open of the day. We reached it here, sold off sharply, vacuumed down to the January 30th high, the 60-minute moving average. We rallied again, and a lot of these bears down here are trapped. They scaled in higher. I suspect we're probably going to oscillate around the open of the day going into the close. Daily chart, bulls and bears deciding what kind of bar we're going to get. Now, does the close matter all that much today? Not so much. Middle of a tight trading range over the past 3 days, in almost an inside bar with yesterday. So it's basically a triangle. Tight trading range, that's a breakout mode pattern. What about buying above 72? It's really not that great of a bull bar to buy. It's a doji 5-bar bull micro channel with a big tail above, and that lowers the probability of buying it. But this is a strong enough rally that I think we're going to go more sideways than straight down. Then straight down. But like I said, we could easily test down to the 62 high, which is right around 62.75. Looks like we're getting vacuumed down, back down to this price level. So 60.73, enough of a surprise. We'll probably get at least a small second leg down. So good for the bears. For the bears, next target down here, 63 low, 57 close. But we're in a trading range, and this could just be a retest of the bar 63 high, the breakout point. At the moment, probably going to go mostly sideways. The bigger the tail we have on this bar, the less traders will be willing to sell the close. Possible wedge, 1, 2, and 3. But 73 is a little bit of a surprise, and that makes me think it may go a little bit lower. Disappointment bar on 73. Obviously, not good for the bears. Increases the probability that we're going to go more sideways here. Tail 73, but enough of a surprise, we may get a small second leg down. Bears trying to get follow through on 74 and a vacuum test down here, and they might get it. That's pretty common in trading ranges. Trading ranges are pretty forgiving. You sell down here, use a really wide stop, sell more in the upper third of the range. The market allows you out with a small loss. The market allows you out. So traders that sold here and sold more up here, break even's right there. What if they sold below a bear bar here? Break even would be right here. So 74 is an important bar. The bears need to make up for the tail on 73. More likely, 74 will be disappointing. Inside bar 74, but follow through after 73, so may go at least a little bit lower. But middle of the trading range. What do the bears do if they're short? They probably get out above a bull bar, or maybe 2 or 3 points above any bar. Middle of the trading range, so no surprise that we're getting a deep pullback. We're getting a lot of overlapping bars here, and that increases the odds of more sideways trading. What about buying above 75? I would not. So late in the day, it's really probably better to do nothing here. The bulls want a retest of the highs. Bears want to sell off and test to the 57 close. I think the market is trying to get down to this area and relieve those bears. But not all that clear. And really not a good area to be buying or selling. May get vacuumed back up to the open of the day. But again, at this point, really just better to wait until tomorrow. This is about closing above the high one yesterday on the daily chart. The bulls are trying to get up there, and looks like they probably will. I'll talk in about 2 or 3 minutes, and so give me just a few minutes, and I'll start the end of day review. Interesting day overall. You can see that the bulls, we had a buy climax on 78. And just when you think the market's getting clearly bullish in trading ranges, it often pulls back. So big bull bar looks like it's getting bullish, and then it pulls back. Big bear bar becoming always in short, and instead of breaking below all the bars to the left, it's a trap, and it leads to 2 large legs up. I wouldn't be surprised if we end up getting all the way back down here. I want to check something. You can see a measured move up of these bars is all the way up here. It'd be interesting to see if we sell off and test all the way back down to the 57 close. In theory, the bears who sold here and sold more anywhere up here made money. Well, that's the logic of bears selling here, scaling in, using a wide stop. They're hoping for a retest back down to this area. Daily chart. We have a bull trend and another small range day. The market's deciding, are we going to get to 5,000, or are we going to test back down to the January 31st low? At the moment, the odds are, even if we get down here, we're going to test 5,000. We came within 2 ticks of 5,000 a couple of days ago, and the chances are whatever pullback we get will be brief, and the market will retest it. I'm going to adjust the monitor really quick. First bar of the day, we have a wedge, and you can see it right here. We have a possible wedge, 1, 2, 3. You can also call it an expanding triangle here, here, and here. So 1, 2, 3, 4, 5, 6, 7. Expanding triangle, top of the trading range. Doji bar on bar 1, following a gap up. probably the first reversal down will fail and we'll continue to go more sideways to up. Bar 2, a bear bar. Probably buyers below 2, sellers above 2, but the sellers may not come in until we get above 1 or possibly the highs up here. 3, a little bit of a surprise, may go a little bit higher, but look where you are. You're trying to break out above yesterday's bar 74 and the high of yesterday, this blue line. This is a high 1 buy signal on the daily chart. All inside bars are always high 1s. And because of that, it's reasonable to assume that the market is going to try and break above the high 1. And it did on 4. We broke above the high 1 and immediately pulled back on 4. For the bears, it's a low 2. You can call it a double top with yesterday's high, but it's a bad sell signal bar on bar 4. Lowers the probability of traders selling below it. And then bar 5, bear breakout on 5, but a big tail below the bar. The breakout below 4 is big enough. In other words, this bar went down far enough that we'll probably get at least a small second leg down. Plus, it's in the upper portion of the range, and that will increase the probability that we go more sideways. 7 or 6, surprise, bear breakout, 3 consecutive bear bars. Probably sell the close and going at least a little bit lower. But what do you notice about 6? 6 is a relatively big bar, and it's breaking out of this tight trading range, but we have this trading range down here. So as strong as 6 is, I think the chances are the downside is probably limited. What about buying the close of 6? I would not. Chances are we're going to get at least a small second leg down. 7, follow through after 6, consecutive bear bars. Is it sell the close? It might be, but I suspect we'll probably get a deep pullback. We're testing yesterday's close, bar 81, and because of that, we'll probably bounce. We're close enough to the moving average, the 60-minute moving average. We'll probably have to get there, and you can see we spent most of today testing it repeatedly. And then bar 7, inside bar reversing up, but it's a weak stop entry buy, and that will increase the probability that there's sellers above. Because it's an inside bar, it's a possible final flag. So if we break below this bar, we'll probably reverse up. And then 9, bear breakout, but again, possible final flag on the prior bar. We have the lows of 1 and 5 right here. It's a double bottom. Chances are we'll probably have to test back to it or test closer to it. Trading range day overall. And until we break clearly above or below this overall range, chances are we're going to go more sideways. And the bulls that buy and scale in lower probably will make money. 7, bull bar. What about buying above it? I would not. As strong as 7 is, it's following a micro channel lasting about 5 bars. Therefore, probably sellers above 9 and sellers above 10 and more sideways trading. 10's enough of a surprise. We'll probably get at least a small second leg up. But there may be buyers, but the buyers may not come in until 50%. 11, bear breakout. Trying to trap the bulls who bought the close of 10 and scaled in lower. But 11, it's a big bear bar, so it's a stop entry, low 1 at support, probably buyers below and more sideways. And then we reversed up on 12. For the bulls, it's a second entry buy at the bottom of a trading range. Always in bears, swing bears, I think it's reasonable to get out above 12. Aggressive bulls will buy. But why is there a tail above 12? That will increase the probability that there's probably sellers above 12 when we go more sideways. 13, breakout above 12. Consecutive bull bars, good for the bulls. We're just under the moving average. And the bulls, it'd be better for the bulls if we break far above the moving average. And instead, we got this doji on 14. For the bulls, it's 2 legs up, and it's a bad low too. So they look at this and think buyers below, buyers at the breakout point of the 12 high, scaling in lower. And that's what happened with 15. 15 broke below 14, but it found buyers. However, 15 is a breakout pullback buy and a high 1 buy setup in a tight trading range. That will increase the probability that there's sellers above 15 rather than buyers. And you can see we triggered the buy above 15 and reversed down on 16. For For the bears, it's a second entry sell, but middle of the tight trading range with a tail below 16. You can take the sell for a swing, but not really all that ideal. Tight trading range lowers the probability for stop entries. And then we broke below 16 but reversed up on 17. For the bulls, it's a credible stop entry, but it's forcing traders to buy just at the moving average, and that lowers the probability of bulls buying above it. Forcing traders to buy just at the moving average, and that lowers the probability of bulls buying above it. $18 bear bar, tight trading range, probably going to go more sideways. As far as selling below 18, I would not. It's got a tail below the bar. You can call it a triangle, so close to 50-50 probability. The odds might slightly favor the bears with it being below the moving average, but better to wait and see. I'd rather wait and see a strong breakout below this range. Too much risk of bulls buying below, scaling in lower. 17 breakout, or 19 breakout below 18, but a weak entry bar. Bad stop entry above 19, trading range, breakout mode. The bulls, they need to break above the moving average. Otherwise, we'll probably go sideways and get a second leg down. And then 20, a second leg up after 17. But you can see what happened. As soon as we broke above 14, we reversed down. Just like the bull, just like when we broke above 10 during 14, it reversed down. When 20 broke out above 14, it pulled back. So probably going to continue sideways here. For the bears, it's a bad stop entry sell below 20, probably buyers below. And then 21, we broke below 20 and pulled back. And then you can see 22, reversal up. Bulls getting closes above the moving average. Good for the bulls. Increase the probability that we're going to go a little bit higher, maybe to the open of the day, the green line, breakout points, the 1 low or the 4 low. And then the bulls got consecutive bull bars, 22, 23. For the bulls, consecutive bull bars, is it buy the close? I don't think it's buy the close yet. We have 1 bar breaking out of this tight trading range. We probably need at least 1 more bar. Plus, you're at logical resistance, the 1 low and the 4 low. And then we have a doji on 24. For the bulls, it's a trend line break from 22 and 23. Increases the probability that the bulls who bought the close at 23, hoping for a stronger breakout, are disappointed, and they'll probably use any bounce and test of 23 to sell out of longs. And that's what happened with 25. 25, inside bar, but a micro channel since 21, so I suspect the downside is probably limited. Possible variant of a second leg trap, rally, pull back for several bars, second leg. In the bears are hopeful that 25 ends up being a bear flag, failed breakout of a channel, and then reversal down. 26, breakout below 25, and a bad high 1. But probably buyers not far below. But because it's a bad high 1 on 26, there's probably sellers above the bar, and we're probably going to go more sideways. You're near the top of the trading range, and because of that, a lot of bulls are not going to be eager to buy up here. 27, another bar added to the micro channel, failed to break out above 26 and reverse down, closing in the bottom third of the bar, 27. 4 consecutive bear bars, micro channel since 24. Probably going to go at least a little bit lower, but we'll probably not go that much lower. If you're buying, where's your stop? I wouldn't put it below 21. It's probably down here. Otherwise, I think you have to get out after 3 or 4 consecutive bear bars. Too much risk of a second leg down. And then 28, surprise breakout, strong enough bar, probably a second leg down. 29, a bull bar, testing the January 30th high and trying to reverse up. But after a micro channel from 24 down to 28, I suspect sellers above 29 and more sideways. And we failed to trigger the sell above 29 and formed an inside bar. Probably buyers below and a second leg up. probably buyers below, and at least a retest of 29 and probably the 27 low. The bulls who bought here and scaled in, I suspect they'll make money. Doji 31, more disappointed bulls, probably going to go more sideways to up here. And then we got an inside bar, possible final flag, third leg down on 33. Since final flags, inside bars are final flags, and when you get them in a trading range, usually they often signify the possible turn of a move. And that's why 33 and 34 happened. 34 breaking out to the upside but failed to close above 33, testing the high of 29, probably going to go more sideways here. But there's probably buyers below the 34 low. And that's why 35 reversed up. For the bulls, it's a bad stop entry, but you have gaps above. So you will have some traders buying down here using a wide stop, maybe 4 points below, so somewhere down here, taking a chance that we rally back to this price level around 63. 36, surprise, bull bar, closing the gap at the 27 low. Strong enough bar that we're probably going to get at least a small second leg up. But it's a big bar in the middle of the trading range. And therefore, it's not really ideal. It's one bar closing above the moving average. So let's see if the bulls can get two bars closing above. And then we had a deep pullback on 37, second leg up 38. 38 breakout pullback buy setup. However, the bulls who bought the close at 36 are disappointed with 37, getting out break even up here. 39 consecutive bull bars, but there might be more sellers above than buyers, middle of a tight trading range. So really not ideal to do anything. 40, surprise, bear bar, breaking to the downside, possible expanding triangle on a smaller time frame in the middle of the larger trading range. Probably going to go more sideways here. Probably bulls buying below, scaling in lower. Doji, 41, but probably going to go more sideways. Some bulls bought above 38 and scaled in lower, and this rally is them getting out around break even, maybe with a small profit on their second. 42, consecutive inside bars, probably buyers below, scaling in lower, and that's why 43 reversed up. 43, possible second leg up from the 38, from the 36 bull bar, but again, middle of the tight trading range. We really need a breakout above the tight trading range and follow through. And that was a weak breakout with 44. 44, two legs up, rallied 41, pullback 42, rallied for a second leg 43, 44. Probably going to go more sideways here. And then 45, bear breakout, but probably overlapping bars, probably going to go sideways. Probably buyers below 44, scaling in lower. At the moment, limit order traders fading everything, buying below bars, selling above bars. They are making money. Another inside bar 46. So lots of inside bars today, and that's a big warning that you're in the trading range. Probably buyers below, scaling in lower. And you can see the bulls got an upside breakout on 48. 48 strong enough, so we'll probably get at least a small second leg up. 49 consecutive bull bars, probably buying by the close. Is it by the close? I think so, but not all that clear. I think the bulls probably need one more bar, and now the bulls have three consecutive bull bars with the target just above the 24 high in the open of the day. Doji 51, retesting the high of 44, during 51. Probably going to go at least a little bit higher. High one by 51. It's an inside bar. And whenever you get an inside bar in a breakout, especially in a trading range, usually the market will retest the inside bar within a bar or two. It acts as a magnet. We broke above it on 52, and then 53 we reversed back within the range. 53, probably buyers below for a second leg up, and that's what happened with 54. And then 54, what do? Some traders will buy it, but look at all the pullbacks. Every time we get a big bull bar, 50, we pull back 51. Bull bar 52, pull back 54. Bull bar, and technically on this bar, 54, we're probably going to pull back again. So rally, pullback, rally, pullback, rally, and then we got a bigger pullback, 55. 55, a little bit of a surprise. May go at least a little bit lower. then obviously 56 trapping a lot of traders who were long. What do you do on 50? Do you sell 56? You'll have some traders selling 56. It's a big bar with big risk, so other traders, rather than selling 56, they wait and see the breakout below the overall range. 57, follow through selling, 3 consecutive bear bars. Is it sell to close? It might be, but you're selling at the bottom of the trading range. And then 58, a weak looking bull bar with a tail above the bar, but we have a small tail on 56. And then another leg down, 57, 58, reversal up. For the bears, probably sellers above 58. And you can see what happened, 59, a big bull bar. Consecutive bull bars, probably at least a small second leg up likely. And then 60, we paused. So the bears who sold to close at 57 and scaled in more higher, somewhere above 58, are able to get out around break even. 60, low one short, probably buyers below. 62, second leg up from the consecutive bull bars, 58, 59. The bears, they want a bear bar closing on its low and a test of the 57 close, which they'll probably get. And then we broke out below a bull bar on 62, and instead we found buyers rather quickly. 63, bull bar, reversal up. The market came within 1 tick of the 57 close during 63 and turned up. For the bears, they'll see it as sellers above. They want a 2-legged pullback and then a low 2 and then a downside breakout. But bottom of a trading range, whenever you're at the bottom of a trading range, probability is never as high as what traders want for a breakout, and that's why a lot of traders exit, and they're fairly quick to wait for more information. So the bears, they exit above 63. Aggressive bulls will buy. Follow through buying 64, closing above the moving average. Good for the bulls, but I suspect they probably need one more bar. And they got their one more bar on 65. 65, 3 consecutive bull bars. Probably buy the close for at least a little bit higher. 66, surprise bar. Probably going to go at least a little bit higher, but we may pull back for a bar or two. You can see we tested the high of, there we go. You can see we tested the high of bar 1310, which is bar 756 here, the high of the bar 67 and a half, and high of this bar 67.75. Give me just a moment. Inside bar 67, I think we're probably going to go more sideways. Consecutive bull bar 63, 64, pause 66, pause 67, and then bull bar 68. So it's a little bit of a parabolic wedge at the highs of bar 55 and 56. And then 69, another inside bar. Buy climax, pause, buy climax, pause, another buy climax. There might be more sellers above 69 than buyers. 70, breaking out to the downside, and then 71 tried to pull back, but then instead, you can see it tested near the high close and the high of 70 and reversed down. 71, inside bar, probably, are there more buyers or sellers below? There's probably buyers below, but you're at the top of a trading range and stop placement becomes tricky. There's probably more buyers in the bottom third than there are buyers up here. And the bulls may not come in until we test a breakout point here. 72, bull bar, probably sellers above and more sideways. And instead, we went straight down and without triggering the buy. 73, surprise, but it's enough of a disappointment bar. It's a surprise. Probably we'll get a second leg down, but with the tail on 73, I suspect not many bears are going to be willing to sell down here. There's probably trapped bears who sold too low, and because of that, there's probably bulls and bears buying whatever pullback we get of 73. It's also a retest of the 63 high. The bears sell the high of 63 here. And you can see their entry price is 61 even, and the low of 73 is 61 and a quarter. Inside bar 74, but then buyers on 75. The bears tried to get the breakout and they're failing, which means we may test it back up to here, the open of the day, 69 high, and maybe above 56. consecutive bull bars, 75, 76, and then we obviously got 3 consecutive bull bars. So retesting the top of the trading range, and instead we broke out to the upside, and then we sold off for 2 bars after 78. 78, basically a second leg trap, and that's why you had a lot of profit taking below 79. For stop entries, you can sell below 4, but not great. I think the first sell is below 6, and then the bulls probably, bears get out above 12, bulls buy, and then bulls, some get out below 16, but not ideal. And then what about buying above 17? Again, some bulls might buy above 17, but it's bad risk reward, middle of the tight trading range. If you do, I think the stop goes below 17, or you can argue putting it below 12. And you can see it didn't get triggered on 18 or 19. It never got hit. And then we reversed up on 20. However, I think if you bought above any of these bars, I think you get out, probably end up getting out break even. You can buy above 23, 22, but not great. And then you see the follow through. I think it's better just to get out below bear bar, like 25. For the bears, hard to sell below 27 or even the close of 28. 28 is low in a trading range. But if you do sell below 28, where do you get out? I think you have to get out a couple of points above 35, or as 36 reverses up. Too much risk. We're going to test the 27 low breakout point. And then the bulls, not really a good price anywhere. Maybe they buy above 48, but if you bought above 48, you probably bought above 43. And I think tough call. If you buy above 43, I don't think it's a great buy because the management is pretty difficult. And then bulls, they can buy above 48, 49, betting on a test at the open of the day, but not easy. If they do, they get out below 55. Bears go short, or they sell below 56 or 57, but you're selling in the bottom of a trading range, which is also not ideal. Bears get out 63, bulls can buy, but if they do, I think they get out after 2 or 3 consecutive bear bars on 71 or 72. And then the bulls, they probably start buying 76, 77, and that's probably it. Limit orders, I mentioned quite a few of them. Sellers above here, sellers above 1, even sellers above 9, but I'd rather sell a deeper pullback. Buyers below 11, even though it's bear bar. Sellers above the breakout point of 12, closer to the moving average. Probably buyers at the breakout point during 15, betting on a second leg, but probably sellers above the high 1. And then back and forth here, probably sellers above, but no bar triggered. And then buyers below here. And then what about here? I thought buyers during bar. I thought buyers somewhere during 37 with the big tail below. But 50-50 chance sellers above the high 1 with 38, and probably buyers below 42, buyers down here. And then I thought probably buyers below here, and then really tough to buy below bars here, micro channel high in a trading range when the pullback could be rather deep. Buy the close, sell the close. I thought sell the close 8, 9, or even 10, but fairly dangerous and late in the move. And then what about buying the close at 23? Some might, but you're buying in the middle of the trading range day after a big sell-off here, which will probably get a second leg down. And if you buy the close of 22 or 23 and you start to see 3 or 4 consecutive bear bars, you're definitely wrong, and you got to get out. Probably sell the close 28, but it led to sideways trading because it's at the bottom of the range. And then probably buy the close 49 or 50, but trading range day, probably going to go more sideways. And then 57, 58, maybe sell the close, but low in the trading range. So if you do sell it, you got to be able to, you got to get out above 63 if you're still short. Buy the close 64, 65 for at least a scalp. And I think it's really tough to do anything after that. These, even though you're getting a bear breakout, it's probably more buy the close than sell the close, testing the stop entry price in where original bears got trapped, and then maybe buy the close 77, but just far too late to really do anything. Let me take a look at questions. Someone asked if there's going to be a coaching session over bar counting. There will, and hopefully some information on that will get released fairly soon. But just stay tuned for more information. Okay. Let me read this question here. Question: is it better to set a goal, a profit goal for the day, and then once you reach it, just turn off your computer and stop trading? Or is it better to sit there and watch the market all day and trade? That it very much depends on your goals. On one hand, and there's benefits to both. On one hand, the more systematic you are with the way you're trading one or two setups, you really understand the one or two setups extremely well, the greater the chance you have of making a profit consistently. However, the less opportunities you're going to find in a day. So everything's a give and a take. And on one hand, I do believe that the more you study and the more you try and apply what you're learning, the better off you'll benefit in the long run. Now, overall, nothing replaces studying and looking at charts. So as far as most traders are going to be better off trying to understand one or two trading methods really well, learning those methods and then sticking to them, and then spending a lot of time studying charts, marking up charts, and learning more about price action. Plus, the longer, it's easy. The longer you trade, the more, stamina you have, if you will, for being less prone to making mistakes. However, as the day goes by, you get more and more tired. And if you've been watching charts all day and thinking about the market, you can easily start making more and more mistakes. So it's very important to check in with yourself frequently and make sure that you're not overlooking something. Okay, question. When bar 22 and 23 closed above the EMA, and one is big compared to the EMA, so big bar here closing above the EMA with follow through, I went long one tick above 23. Yeah, okay, I don't see. So the person saying they went long here. They saw 24, 25, 26, and they thought it was a pullback. And they took a loss on 27 and 28. How do you deal with these situations? Yeah, Al talked about that when he was in the room. And the problem buying up here, it's the same issue with anywhere on the chart. If you're buying up here, it's really better to put a stop somewhere down here than it is below 21 or 22. You can buy the close of 22. There will be plenty of traders who buy the close of here and put a stop below 22. Now those traders doing that, they're buying the momentum. And if the market starts to go sideways like 24 and 25, a lot of those traders start to get out break even. And that's what happened. They buy the close of this bar, no follow through, so no momentum. They sell out of their longs back to the 23 close during 25. And you can see the market drifted all the way down. The other idea, I think the worst thing you can do is exit at the 21 low. And I talked about that. You sell out of longs at the 21 low right here. You can see you get stopped out here, and then the market goes sideways for about 30 minutes and then reverses back up. The better stop, if you don't get out early up here, I think it's better to use a wide stop below 12. And the reason is, and look to scale in lower. Some traders, they'll exit as 28 goes down, but a lot of those traders exiting as 28 goes down, they're going to buy. They know that they're going to buy again. They're just getting out because the momentum is strong enough to go a little bit lower. But that's the problem with selling high in a trading range. Same thing down here. if you're selling down here, you have a couple of choices for stops. You can get out early above 12 and then look to sell again higher, or you get out when it's clearly always in long, maybe during here or here. But if you exit shorts up here and you start to get bear bars, eventually you have to sell again. This is a common problem with trading ranges. The market makes you think that it's becoming always in long, and just when you think the market's always in long, strong breakout, follow through above the moving average, but you look to the left, you're above all these bars here. So in other words, you're above this, but you're not above everything to the left. And that increases the probability, that increases the risk that we're going to go more sideways. Plus, this is just not, when you get a breakout late in a rally that began on 12, it's a bull breakout of a channel, and it typically leads to more sideways trading. Question, how early could you tell it was a trading range day? If I placed a limit order at the low of bar 79 yesterday, where should I put my protective stop? Thank you. That is always a good question. So what they're asking is, if they're long, so what they're saying is, if this whole thing is a trading range, 2 legs down, why not just set a limit order at the low of 79 right here, get filled on 12, and then how do you manage the trade? Where do you put your stop? Entering with limit orders, buying below bars, selling above bars, it's kind of like catching a falling knife. And when you buy below bars, a lot of traders, in general, where do traders get out? So where's the theoretical stop? It's somewhere down here, maybe 4 points below the low of 9, the low of 79, maybe 5 points below, but it's somewhere in this general area. And that's what makes it difficult. Some traders, if they got follow through another bear bar on 12, they'd get out. I think a lot of traders, what most traders should focus on is waiting for a stop entry. You know, I get the logic. I'm going to buy on a limit order at the bottom of the range and therefore get a really good entry. But ask yourself, where's your target? If you're buying here at the bottom of 79 and you're setting a target, let's say at the open of the day, then the reality is, if the market's going to get up there, if it's going to rally to the open, you're probably going to get a decent stop entry buy on the day. And because of that, I think most traders are better off waiting for a stop entry, because inevitably what most traders do, especially when they're starting out, they'll buy below 79 and they get the logic. I'll buy below 79 here. I'll sell above 74 here. And if I could do that, if I could sell above here, scalp out in the middle, buy below 79, scalp out in the middle, you know, that's 20, however many points in a day. And that's a really, really good profit. But the problem is, what traders will inevitably do is this. They'll say, okay, trading range day, I'm going to buy the low of 30, of 40 right here. And they have a good game plan. They're going to buy the low of 40. But what they fail to realize is tight bear channel, open gaps, consecutive bear bars, always in short, second leg down likely. And then they see this bar, and they look at that and they say, you know, wow, that's a little bit stronger of a bar. You know, I didn't anticipate getting filled this quickly. That's pretty strong. Maybe I should get out. And instead, they don't get out. They think, it's follow through, but it's not that strong. And before they know it, they're in this trade, and they buy it here. They scale in more here, and they're so panicked and worried about their risk that they end up dumping their entire position here, and they take this massive, massive loss. And then they see this bull bar, and they watch the market painfully go back to their entry price without them. And they start to think to themselves, gee, if I would just wait for a bull bar, you know, if I'd wait for a stop entry, I'd be pretty safe. There's no reason to buy, no reason to sell. You know, these are all low probability. Strong breakout, maybe you sell below that. But even if I was just looking to trade counter trend against the bear channel, 1 push down, 2 pushes down, 3 pushes down, strong bull bar on 16, far from the moving average, increases the probability that we're going to rally for a couple of legs. So that's my only thing. That's my hesitation with limit orders at extremes. I think most traders would be better off waiting for a stop entry. Most traders would be better off trying to trade with stop entries. Limit order trading looks easy. It always looks easy at the end of the day. But most of the time, it's not easy. It's confusing. Nothing's all that clear. You get a bull breakout. It looks like it's always in long, but you look to the left and then it immediately fails. You get big bear bars here, and it tries to reverse, forms a higher low, and then a strong rally here. So anyways, this is, I think most traders, again, I'd wait for stop entries. Let me look for one or two more questions. Okay, question. I was planning a short trade on bar 25 here because I see it as a wedge bear flag, 1, 2, 3, after bear breakout. That makes sense. But Al kept saying until bar 26. That Al kept saying until here that we were always in long. Yeah, so what the person's saying is they look at this sell-off and they think to themselves, maybe they exit their shorts here, but anyways, they're looking to sell a wedge, and they keep looking at this. They see the breakout and follow through, and they think to themselves, gee, that's a wedge. 1, 2, maybe 3, failed breakout of this tight trading range. Maybe it's a 50% pullback from here to here, so it's just barely above 50%. And they see this bear bar here, and they think, maybe I'm going to sell below that. If I sell below it, put a stop up here, maybe put it a point or two above 24, and then set a target at the low of 12. It's fantastic risk reward. But they didn't take the trade because they said Al was saying it's always in long. It is always in long here. One of the things, and for those of you listening, I would encourage you to write this down. Trading ranges, by the time the market appears always in long, they often fail in reverse. So always in long here, breakout follow through. What Al is saying is we have to think about the market as a cycle. We have a trading range on the open, starts to trend with 6, 7, 8, and 9, but it's at the bottom of a trading range. And then somewhere in here, we go back to a trading range. The market's in a trading range. Trading range bars here. And then we get this bull breakout, maybe follow through or bull breakout on 23. The market is starting to trend above the moving average. You're getting strong trend bars. Starting to trend and a relentless small pullback trend are on two opposite ends of the spectrum of trending. So what that means is what Al is saying is the market is becoming always in long. But here, these two bars, that's a lot different than what we see right here. Look at this weekly chart. Lots of big bull bars, or, better yet, the monthly chart. 3 really big bull bars. That's a lot different. These 22, 23 are much different than what this looks like on the daily chart. Here, breaking above the moving average, holding above the moving average for a lot of bars. Probably best that the bears can expect is sideways. Here, we've been always in long for a few bars, and it's subjective. Whenever you look at the market and you think the market's always in long, but then you think to yourself and you think, I don't know, if we get a big bear bar closing on its low, it's probably always in short. It's probably back to always in short. Then you know that you're in a trading range, and that's what happened here. Al thought first reversal down will probably fail, but then the bears got a strong enough breakout below 25 that the odds were they'd get a small second leg down, which is what happened on 27. So that's why Al was saying always in long here and then always in short. A lot of times, traders use always in to describe context, but when you're in a trading range, traders flip back and forth between always in long and always in short quickly. So just because he's saying always in long here is not insinuating that he's extremely bullish. He's just saying that it's a breakout with follow through and you may get a second leg. And that's, go back to the recording and listen to Al carefully talk about bar 6. He said it's always in short, but bottom of the trading range. And because of that, it's not really ideal to be selling down here. He'd probably say the same thing about the bulls here. Someone asked if I could change the color of the bar counting numbers. Yeah, that's one thing I'll figure out today. I was thinking the same thing. They're gray, and they looked different on TradeStation 10, but they're slightly grayer. So I'm working on trying to change the font. Okay, question was 16, a reasonable swing sell, taking a chance that we get a second leg down from 4 to 9. 16, a reasonable swing sell. It's a second entry sell, but it's middle of the tight trading range, and there's a tail below 16. And to me, that lowered the probability of traders selling below it. It's not an unreasonable sell, but it's a low probability sell. And, it's kind of tough. If you sell below 16, do you put a stop one tick above 16? I don't know. That's probably, I think it's better. If you're selling below 16, I think it's better to probably use a wide stop. And then you can see what happened on 17 and 18. Fear sold below 16, wide stop. What's wide? Somewhere up here. And they'll be quick to exit. It reverses up on 17. They sell more higher. They try to sell more above 16. And then you look what happened on 18 and 19. It retested the 16 low. So bears sell below 16, disappointed 17 and 18. They get out break even at the 16 low. But as far as, whenever you get a lot of overlapping bars for stop entries, it lowers the probability quickly. So here, the problem you have selling below bars is the same problem you have here, selling below bars, or buying above bars here, or buying above bars here. You're in the middle of a tight trading range. Obviously, this, a little bit of a wedge, 1, 2, 3, 1, 2, 3. But overall, I thought selling below 16 was low probability. But if you did take the sell and then you get bull bars like 17 and 18, I think most traders are better off getting out. You sold below 16 because you were hoping that 17 here would be a big bear bar, and instead it was a bull bar, and that lowers the probability. And because of that, that's a warning that there's no momentum on the trade. Therefore, a lot of traders exit. So where do we go tomorrow? We have an inside bar. And as I said a couple of minutes ago, we're obviously in a bull trend. There's probably buyers below in this area, but we're so close to 5,000, I suspect we're probably going to get there. So at the moment, I think it's more bullish than bearish. The question is, do we pull back more, or do we gap up and go, or do we rally back to 5,000? I do believe we're going to get to 5,000. I just don't know the path. We came within 2 points, so the market tested 5,000. It came within 2 points in one tick. So it tested 5,000, but I suspect we may pull back more and then get to 5,000. I do think we're going to go above 5,000. And then looking at the higher time frames, I suspect we're probably going to spend a lot of time around 5,000. It's possible this month reverses down, but after 3 consecutive strong bull bars, we're probably going to be mostly sideways. We're probably going to go sideways up here rather than reverse strongly down. But we'll see. Okay, thanks everyone for watching, and I will talk to everybody soon.